Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning, you're with us here on a fresh new edition of Bazaar Morning Call, a fresh new week, Monday morning, coming out of course, what has been a very tentative and kind of watchful weekend, especially with regards to the tensions between India and Pakistan. I mean, I think that's the number one talking point still, even as we look at what lies ahead. We are, of course, coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant, with me my colleagues Nigel and Surbhi. Guys, hi, good morning.
Hi, good morning, folks. As Mercury keeps climbing here in Mumbai, I think the other watch point really has been, I mean, domestically, that's been the biggest cue in terms of what next, a series of meetings.
Yeah.
But at least there's some calm on global screens. We haven't woken up to another shocker or a bazooka from Mr. Trump, so that's good.
Well, that's right. And April has actually belonged to the Indian markets because we have been outperformers. Last week, we saw some bit of consolidation, but otherwise, we have been the outlier in the month of April itself. And, the next few days, we'll say goodbye to April and let's see what May holds for us.
Well, that famous saying which...
Sell in May and go away.
No, I don't think... I think, it's quite incredible. I was looking at statistics. India is now right at the top.
Yeah.
Even after Friday's fall, right at the top
Yeah.
in terms of large major markets, in
Indeed.
terms of returns. From that Liberation Day,
Yeah.
2nd of April. So let's just sort of take it from the top and, tell our viewers exactly some of those numbers. So India is the best performing Asian market since April 2nd close, which is the Liberation Day close. The market's up 3% from that point. So that is quite something, right? The Nifty is also, by the way, crept back into the positive territory on a year-to-date basis. We're up about 1.7% or so. So these are good numbers to look at. Now, FPIs, and we were sort of looking at that number middle of last week as well. So they've been big buyers. The week before last, there was only 3 sessions. They bought about 15,000 crores. You add up what they did last week as well. So in about 8 sessions, FPIs have bought stock worth about 32,000 crore rupees. That is a very large number we're talking about, which has come back. Of course, as a percentage, if you can move the graphics along, as a percentage of what we've seen over the last many months in terms of what they've sold, this is still small. The big risk, which I think, as I said, markets have been very watchful about, of course, is still the India-Pakistan tensions and how this will go forward. Some have been of this firm view, and if you read editorials in newspapers and, general reporting, etc., that diplomatically, India has kind of done what it wants to do, and now will it take it one step forward? You also are starting to hear commentary from, this morning, last night, I think there was something from the US State Department, we're hearing something from China. So this is, I think, the reason the market sold off so aggressively on Friday. Remember, even on Friday, if you look at the institutional number, that was a big positive. But the market was down about 0.8%. And I think this is essentially the big reason why. And I don't think that kind of goes away. That sort of risk kind of does not go away in that sense. For US as well, right? So India and US had been the 2 best performing markets for a number of years, large markets. So think about it. Last Monday, the big theme which was in vogue was selling US exceptionalism, right? US assets, dollar assets. By Friday, it had completely flipped around. It just tells you the nature of things. So just look at this. S&P 500 by Friday's close was up more than 8% above Monday's low. Just 1 week, Monday to Friday. And I think, US was really the big highlight in that sense. And Friday has not been bad. So Friday, S&P about 3/4 higher, NASDAQ about 1.2 higher. This week, on 30th, essentially, you'd have 100 days of, President Donald Trump's second term, which comes to an end. So the first 100 days in that sense, there'll be lots of, already there are a lot of, I think that Time Magazine interview and so many others essentially this week you will see centered around what he's done, what he's been able to achieve and what he's trying to achieve so far. Markets, of course, in terms of clarity on trade talks, still looking for the big one. What is that big one? It sounds kind of bizarre, but markets are looking for clues whether US and China have actually begun to talk. Because last week we were hearing that one side is saying, yes, we've started talking. The other side is saying was essentially denying it. So I think that remains the big one. in that sense. Now, this week, S&P Global PMIs are important. There is some other data as well. For example, this week on Friday, you will get the jobs report, coal piece, but none of those will show the impact of tariffs. What essentially will matter is PMIs, because that is essentially slightly forward-looking, and it's a survey. So, global PMIs in focus. Results, big results from the US. Microsoft, Amazon, Meta, Apple should be in focus as well. And just to sort of come back to our levels and tie in things, India continued the up move. As I was saying, Nifty 0.8 higher last week. Bank Nifty about that much. Mid-cap index was up about 1.7%. So where do we go from here? The upside is pretty clear. For the Nifty, for example, it is a 61.8% retracement, which is about 24,545, 546. But supports, Friday's low becomes important. 23,847 is that number. And below that, the next support comes in at 23,593. For the Nifty Bank, similarly, resistances we put out many times and we've kind of sort of come off those levels. Support comes in, which is the Friday's low, 54,176. And the next support comes in at about 53,735. GIFT Nifty, I think, is indicating a small, not so small as compared to when I saw in the morning, about 115 points higher on the GIFT Nifty this morning. Surabhi.
Absolutely, but I think the funniest part of all this is, are we talking, are we not talking? Because there was more of that on Friday as well, where Trump again made a statement that, no, we're talking and negotiations are on. Yeah. And then the Chinese embassy in the US issued a statement saying we're not talking, there are no trade consultations underway. And somewhere over the weekend, there was also a statement from, I think, Scott Bessent saying that first there'll be some tweaking of tariffs, they'll be lowered, and then the talks will begin. So that's, another level of geopolitical trade bazaar. But anyway, just to come back to cues here, now Asian markets are trading fairly mixed. They started off quite positive. The Japanese market was up almost 1%. But once China started opening up and the Hong Kong market opened up, the colors changed now. So there's a fair bit of caution out there. It's really all eyes on China. Why do I say that? First of all, there's a briefing expected today from the PBOC, from, the top brass of the Chinese establishment, basically. You don't know which particular institution. And it's all eyes on expected additional stimulus measures. And why has this now become center stage for the market? Because the Chinese finance minister issued a statement over the weekend, Lan Fon, saying that China will adopt more proactive macroeconomic policies to promote the realization of growth this year in the country and to continue to bring stability and momentum to the global economy. So China seems to want to play its big role in terms of stabilizing global trade as these tariff negotiations weigh on sentiment. And that's why we're expecting that press briefing. More measures could be detailed soon. On China as well, the good news in terms of the macroeconomic numbers is the industrial profits data that came in. In March, there's a big pickup in industrial profits. The number is up about 2.6% year on year. And it has got the overall first quarter number back into growth territory. The growth is about 0.8% versus the decline seen in January and February, which are anyway Lunar New Year holiday. So that's a seasonal impact. But anyway, industrial profits looking better in China. Now, this Time magazine article, Donald Trump speaking to Time magazine, he's made a couple of interesting points there. He's saying that we would consider it to be a victory for the US if the US can impose anything between 20% to 50% tariffs on its trading partners, all countries around the world, by the end of 1 year. So what he's saying is by the end of negotiations, it'll be a US victory if we can do 20 to 50%, which would still be substantially higher than where tariffs have, of course, been historically. And then he goes back to his favorite, the bond market. Remember, it was everybody said the bond market forced Trump's hands. He quips and he says, and I quote, "The bond market was getting the yips. I wasn't." When he was questioned about the whole, walking back and announcing this 90-day negotiation window. Anyhow, coming to our screens here, the Indian market has continued its upward trajectory, though with the consolidation on Friday. Overall, for the week, we've been flat. And right now, the market is about 8% away from the peak, having become the best performing market in most of the world since Liberation Day. Flows picture still looking very solid, despite a lot of geopolitical concerns here in India. There was net buying, almost 3,000 crores of net buying in the cash market on Friday. Domestic institutions were also on the buy side, and they pumped in about 3,500 crores. This is Friday's data. Important numbers and corporate developments. Two I'll quickly pick out. Of course, Reliance Industries and more analysis coming in. But in a nutshell, the retail business has done really well. There's been the EBITDA for the retail business is up about 15%. There's been some weakness in Jio. The ARPU growth of 2% is not as strong as what the market was anticipating because of lesser working days, and the tariff impact perhaps finally being factored in. The O2C performance is a little behind the curve because of weakness in petchem cracks and transportation fuel cracks. And oil and gas, the exploration and production part of it, has been slightly shy of estimates because of lower production in KG-D6 and maintenance shutdown. So that's Reliance in a nutshell. Numbers are largely stable. I mean, there's nothing very big on the way down, and retail actually is looking better than expected. M&M is the other stock in focus. Big deal. It's finally happened. SML Isuzu has a buyer, and it is Mahindra and there'll be an open offer as well. First, they buy about 59% equity. Then they launch an open offer at 1,554 rupees per share. So these two become really important stocks in news. And last but not the least, I will definitely not take my eye away from the geopolitical developments here, India, Pakistan, and what the latest is. Last night, the Chief of Defence Staff, General Anil Chauhan, he met Defence Minister Rajnath Singh for a complete briefing on the situation. The Army Chief was in the valley over the weekend as well. The Navy is on high alert. It's been conducting a lot of strikes and test firings over the weekend as well. So high alert. It's a wait and watch. Have to keep our eye on the ball over here as well. Nigel?
Well, a quick comment first on Friday's trading session. That buy on dip did work out. And in fact, you did see that play out in Friday's trade. So I think till that 23,800 odd mark holds out, the bulls will believe that this is still a buy on dips market. Also, the institutional number was quite encouraging. But for the past week itself, the Nifty was a relative underperformer. Though for the month of April, we have been outperformers because from that Liberation Day lows, the Nifty is actually higher by close to around 3%. Though for last week, we were up little under 1%, while the US markets are up 2.5% to around 6% or thereabouts. There has been a bit of consolidation. Some of those technical indicators like the RSI Relative Strength Index, they had gone into the overbought zone. And also some kind of cooling off after the one-way run that we saw. So that could be the reason that India underperformed just for the past week. What did the FIs do? Well, they added some short positions. And I'll view this positively because even at the start of the previous series, we did have the FI shorts were relatively lower. And as the series progressed, they did add some shots into the system and they were not getting follow through on the downside. And because of that, we did see a short covering bounce. So some shots getting added into the system. You have the net short positions at around 62% or thereabouts, relatively shorter in absolute terms, smaller in absolute terms in comparison to what we have seen. But shots getting built into the system, I don't view it very, very negatively. Focusing on the options data then, you have the 24,400 call, 24,500 call. Both of them were fairly active. So that those become crucial resistance zones. While on the downside, that 23,900 put, well, that continues to see some addition. The premium out there is close to around 100 rupees. So that brings us to the levels you're looking at. The recent high, recent low, well, that becomes a bit of a reference point that you're looking at. So the near-term range is quite cut out. That's around 23,800 on the downside, 24,400 on the upside. And these are the recent lows that we have seen, as well as the recent high. So those become reference points that you're looking at. But otherwise, I believe the markets are in a bit of a range. And the RSI out here as well has cooled off to around 61. Moving to the Nifty Bank, that RSI had moved into the overbought zone. It had gone all the way to around 75 or thereabouts. Now that's cooled down to around 67. So it's come below that crucial 70 odd mark. Support, that's closer to Friday's low, which was at around 54,100. Important mark to protect on the downside. While the recent high, around 55,350, well, that's the important mark. I think the Nifty Bank again holds the key because it's seen some bit of cool off from that 56,000 odd mark. And if the bulls need to fight back, this one will have to find its form. Moving to the stocks that I'm looking at for today's trading session, the big deal has been announced. Mahindra has gone ahead and bought SML Isuzu. The stock that I'm looking at is JBM Auto because, on the day that we had broken the story itself, JBM Auto was the one that did see a bit of a run. So let's see whether or not, how this stock moves in today's trading session. Besides those two, I'll keep an eye out on this one. The other stock I'm looking at is Manappuram, because we have, and Muthoot, because Chola, they are going to be foraying into the gold loan business. So Muthoot is the one that I'll be tracking for today's trading session because suddenly you have a big player that's coming into their space. Valuation is not very, very cheap and basically it increases the competitive intensity. So Muthoot is a stock that I'll be looking at for today's trading session. That's the second one. And Reliance, they were speaking about getting quite seriously into the quick commerce business with that 30-minute delivery. So the two stocks that I'll be looking at will be Swiggy as well as Zomato. Both of them will be on my radar because you have a big name that's looking at that important quick commerce space. So we'll keep an eye out on both those two.
All right, Nigel, thank you very much for that. So that's essentially the setup and, of course, names to keep an eye out on as we begin this new session. Jeffrey Dennis is with us, independent emerging markets commentator. Jeffrey, good to have you with us here. As always, good morning. As I was saying, India's back to doing what it does best, which is doing very well. Even in a relative sense, maybe not in an absolute sense, we're up about 1.5% year to date. Best performing Asian market from 2nd of April. And the so-called Liberation Day tariffs. What's your sense, Jeffrey? Friday, the market sold off because this potential escalation is a risk which markets are focused on. But beyond that, what's your sense?
I think we're back in the story of really, do people want to buy China or do they want to buy India? And those are two markets which often are looked at as alternatives. And you've seen a sizable pullback in China in April. And India's been the big beneficiary of that. And I think, and I've argued this for quite some time, I would expect India to continue to outperform China. You mentioned in the intro how the Chinese government's committed to supporting the domestic economy, playing its role in the global economy. Well, how many times have we heard that in the past? The issue in China remains the same. A lack of consumer spending growth and a major property sector problem. So I think the long-term bet is still better in India. As I've also argued many times, India is, of course, if the reciprocal tariffs come back in 90 days or less than 90 days now, of course, from the US, it is a little bit more, I think, protected from those than the other big Asian markets. And of course, it's a slightly more closed economy. Oil prices coming down benefit to India as well. So I think India looks quite good on relative terms, certainly compared to China, certainly compared to the rest of Asia, although there's some pretty big gains in other emerging markets. So I think we have to keep that in mind as a comparison also.
Okay. Fair point. Mr. Dennis, good morning. Great to have you on the show. On a side note, aside of all the tariff issues, the geopolitical local developments here in India, how would you view them? Because there's an absolute wait and watch going on, meetings all across. And of course, you'd be aware of a lot of the comments that are coming out. Could that become a concern, or would it be a buying opportunity if the market dips?
I think we just don't know at this point. We have to see to what extent there's any further escalation in this issue between India and Pakistan over the tragic deaths of the tourists. My bet would probably be, and I think you're in a better position to argue this than I am, but my bet from afar would be that, as often seems to be the case with some of these Indian and Pakistani periods of tension politically, that it will eventually settle down. It'll turn out to be a buying opportunity for India. But I think it's a little bit too early to tell. There are weekend headlines, as your caption actually indicates, and I think it's just too early to tell. But I don't think at this point that we should assume over the next 3 to 6 months, something of that order, that this is going to be the big driver of the Indian market. And the big driver of the Indian market will be the domestic economic situation and the situation vis-a-vis the US and tariffs. And I think we should keep our eye probably on that main story, while accepting in the short term there is some risk coming from this security situation.
Indeed. Talking about tariffs, Jeffrey, I wanted to ask you, what do you think the global equity watchers will be satisfied with? Because some of those tariffs that Mr. Trump has laid out are very, very high. Case in point being, China at 145%. It has to come down. What do you think would be the level that would be acceptable? It would be taking off some points from the global GDP number, but what should be the realistic assumption with regard to tariffs? Even if it's 25%, it's still going to be higher than what it was a few months ago.
I prefer to say that the acceptable level is zero, but I guess we're not going to have zero. But it is the case that if we get anything like the latest idea, which is, as Trump has said, 20 to 50% on a whole variety of countries, this still leaves US tariffs at the highest level they've been for 100 years. And I think this is disastrous for the global economy. I think it's disastrous for the US economy. I think we are in a situation here where, despite this so-called panic buying of goods from overseas by both consumers and companies, and of course including capital goods from overseas for companies, you are going to see eventually a sharp slowdown in the US economy as we head into the second half of the year. Inflation's going to pick up. There's a lot of talk about challenges coming with shortages of goods on the shelves. People are not going to be happy with this, and I think the market is going to struggle. And I'm still believing that, having seen the big sell-off and a very nice rally now, we're now trying to find out what we're going to do. And my gut feel is certainly a 3-month basis, markets will be low from here. I think the dollar will turn lower as well. Actually, and the bond market's going to get torn between the economy being weak and of course, the sense that people want to sell the U.S. And so that's going to be a tug of war, I think, on the bond market. But in terms of tariffs specifically, anything along the lines of what he's saying here is just, to me, it's madness. It's crazy. And I don't think the markets will eventually get to a level where they price that in. Although pricing that in will probably mean a weak U.S. economy, very weak U.S. economy for a period of time. But I would hope to see that with this, that Trump is talking about, that we may get to the point where tariffs are going to be lower than those levels that we've just talked about. But we must wait and see. But I think the market is going to be ultimately disappointed if tariffs are going to be 20 to 50%, because that's just terrible news for the global economy.
All right, no, absolutely. We'll leave it there, Jeffrey, and speak to you soon. Again, appreciate your time here, and thank you for taking us through that view. Well, let me just quickly run you through the interactions which are lined up here over the next 2 hours or so. So you'll hear at 8:35 from Gaurav Malhotra of Axis Capital, Karan Thurani, Vilara, and Prabal Sen of ICICI Securities. They talk to us about the Reliance numbers, which came on Friday. 9 o'clock, you'll have the management of Dr. Lal Path Labs on their fourth quarter earnings. 9:20, Pratik Gupta, Kotak Institutional Equities, will talk to us about markets. Tata Technologies reported numbers, and Warren Harris will be with us to talk about those numbers. We have two NBFCs, Chola Finance at 9:40 and then Shriram Finance at 9:50. Both reported numbers, into the fag end of the session on Friday. And of course, 10:15, Lata will be in conversation with the IDFC First Bank management on their fourth quarter earnings.
Well, time to slip into a short break, but we've got a lot of stock-specific action to track for you. We get to that in just a bit in our special Top 10 segment. For the time being, I give you a sneak peek. We're looking at Reliance, Mahindra & Mahindra, IGL, Zensar Tech, Poonawalla FinCorp. All of them will be reacting to positive news flow. Add to the list, India Cements. While on the flip side, you have SML Isuzu, LNT Finance, Tata Tech, and IDFC First Bank that will be reacting to negative news flow. Take that break, come back, get into further detail on all of these names.
Welcome back. Well, as we've been telling you, cues across Asia have turned a little more mixed. But the implied open suggests that we'll still go on the positive side. I mean, more in swing with the, let's say, the Taiwan market or the Japan market than the Chinese markets. There you go, 122 points higher on the implied Nifty. But lots of stocks to track, lots of earnings over the weekend as well. So let's straight away get to it. Our team is standing by with the CNBC-TV18 list of top stocks to watch. Guys, good morning to all of you. Let's start off with Reliance Industries, Rima.
Well, it was actually a pretty good set of numbers. With the appropriate disclosure, Reliance Industries has clocked in a very strong, steady and a good performance. The key positive was acceleration for Reliance Retail. Reliance Retail's top line grew by 16%, EBITDA expanded 15% on a year-on-year basis, and that was a beat. Even the oil to chemicals business, yes, overall it was subdued. The O2C EBITDA declined year-on-year, but it was still higher than street expectations, while Reliance Jio clocked in a steady quarter. On expected lines, the average revenue per user expanded. The company added subscribers by nearly 6 million sequentially. Also, the positive is the new energy plans are unfolding for the company, and that needs to be tracked very closely. So the company has now commissioned a gigawatt-scale HJT technology-based solar module plans. So details on this, the street is quite excited about. Quick word on the brokerages. Nomura has raised the target price to 1650. 3 triggers to watch in the near term. 1, scale up of the new energy business. 2, watch for upcoming tariffs from Reliance Jio. And 3, monetization, particularly Reliance Jio. They say Reliance is their top pick in the energy sector. JP Morgan Stanley also overweight on the stock. For JPM, the target price 1530, Morgan Stanley 1606.
Okay, all right, Rima, thanks a lot for that. Well, let's focus on the big deal that was announced on Saturday night. Sudarshan joins in to tell us about Mahindra and Mahindra going ahead and finally buying SML Isuzu. Sudarshan, morning.
Morning, Nigel. So what our sister channel had reported a month ago is now confirmed by Mahindra and SML Isuzu. So both the companies have announced that M&M is going to acquire nearly 59% stake in SML Isuzu, and of that, nearly 44% stake is going to be acquired from promoter Sumitomo Corp and 15% from the public shareholder Isuzu Motors. And this acquisition from promoter and from Isuzu will be done at a rupees of 650 per share, and that would be worth almost rupees 555 crore. Apart from this, Mahindra and Mahindra will also make an open offer to acquire additional 26% stake, and for open offer the price is rupees 1555, which is a discount of almost 12% to Friday's closing price. It's an all-cash deal, and both the companies expect the deal to be completed by December of 2025. Now, what's the objective of M&M going ahead and going to acquire this stake from SML Isuzu? The reason is M&M is looking to expand its truck and bus business. Currently, in the capacity of CV, that is of more than 3.5 tons, in that one, M&M's market share is almost 3%. And SML Isuzu also has market share of around 3%. So M&M post-acquisition, the market share will increase to 6%. And in this segment also by 2031, M&M is looking to increase the market share in the range of 10 to 12%. And by FY36, it's looking to increase market share of more than 20%. So considering the price in which the deal is done, it's a good deal for M&M as far as M&M is concerned. But I'm going with red for SML Isuzu because the stock has run up significantly over the last few months. In 2025, the stock is up almost 26%.
All right. So thank you very much for that. So keep an eye out on those two names. LNT Finance is the next one we want to focus on. Abhishek is here with details. Abhishek, morning.
Morning, Prashant. So to begin with LNT Finance, the disbursements growth was really weak and asset quality also deteriorated over there. So take a look at disbursements. They are down by 2.95% on a YOY basis. It's the highest decline that you are seeing in last 8 quarters. Now, YOY and quarter-on-quarter decline in disbursements were seen in two-wheeler, rural, as well as housing finance and retail business. Asset quality, one of the worst that you are seeing in last 7 quarters. Gross NP ratio has inched up to 3.29% versus 3.23% in the previous quarter. When your disbursements are weak and your asset quality deteriorates, the NII growth weakens, and NII growth rate of 1.4% YOY is the lowest that you are seeing in last 11 quarters. There is a sharp decline in net interest margin by 35 basis points sequentially. Hence, the net interest margin is at 7-quarter low. Now, AM growth is also weak at 14.3% YOY and just 2.8% sequentially. AM growth declined both YOY and quarter-on-quarter in real estate financing, infra financing and wholesale financing. Back to you.
Okay, all right, got it. Thanks for that, Abhishek. Let's move forward. We have Sudarshan joining in on IGL. So, good morning.
Morning, Surbhi. So, companies reported a healthy set of earnings for Q4. It's an operational beat. EBITDA has increased by 37%. It has come in almost 500 crore. And estimates sort of for EBITDA, it was around 410 crore. So, it's a beat on this front. Margin has also increased to 12.6% in comparison to nearly 10% in the Q3. Volumes were largely in line. It has come at 9.2 MMSCMD, and that is the flat on a sequential basis. The biggest positive, EBITDA per SCM. The estimate for EBITDA per SCM was around rupees 4.80, say rupees 5, but company has reported EBITDA per SCM of rupees 6, and that should be taken positively, and that's the reason I'm going with green for IGL.
Okay, all right. Thanks a lot for that, Sudarshan. Well, let's go back to Rima. She's here to tell us about Tata Tech as well as Zensar Tech. Rima, take it away.
Well, let me start with Tata Tech. The top line was a tad bit subdued. The company's constant currency revenue growth declined by 3.3%, but the EBITDA margin performance was better. Margins improved to 18.2%. The auto part of the business struggled, while the aerospace business, which is a smaller portion on a low base, has actually done very well with an 8% growth. So that explains the top line. The company also said the BMW JV is actually ramping up ahead of schedule. JP Morgan has an underweight call on Tata Tech, and they're saying we're expecting a low single-digit revenue growth in FY26 with flat margins. Keeping that in mind, the current valuations of 37 times PE is expensive and not justified. Zensar has reported a pretty decent decent numbers given the context. Revenue growth was at 0.9%, margins up 10 basis points. The total contract value of deal wins up 4% quarter on quarter. So at least there is some growth, compared to many other companies where we've seen revenues drop off. The problem is manufacturing and healthcare, that declined for the company. And the company in the conference call said that they anticipate FY26 to be better than FY25.
Okay, all right. Got that, Rima. Thanks very much. Back to Abhishek then. More numbers on the financial front. IDFC First Bank and Poonawalla FinCorp. Abhishek?
Well, IDFC First Bank, they have overshot their credit cost guidance for FY25. So their FY25 credit cost is at 2.46% versus the guidance of 2.25%. In terms of our poll, both the ANA and PAT, they are lower than our poll. Microfinance SMA 1 and 2, that book increased to 5.1 versus 4.56% in the previous quarter. So watch out for MFI stress in the coming quarters as well. Net interest margin is at 10-quarter low. NII growth on a YY basis is less than 10%, the lowest that you are seeing in last 22 quarters, and just 0.1%, which is the lowest in last 19 quarters. ROA continues to remain weak. Quarterly annualized slippage ratio has declined a bit by 20 basis points, 3.73 versus 3.93%. And thanks to a write-off of 1,486 crores, gross NP ratio is one of the lowest that you are seeing in last 17 quarters. Now, Poonawalla FinCorp, unbelievable, the AUM growth is unbelievable, robustly high with respect to all the lenders that you are seeing. Operationally, a weak P&L over there. So AUM growth is at 42.5% YOY and 15% quarter on quarter. No other lender has seen this kind of massive growth. The NII growth is weak at 11.5% YOY and just 6.4% quarter on quarter. Weak with respect to if you compare to the AUM growth. Operating profits have declined by 41.8% YOY. PAT is down 81% YOY and it's up about 233% quarter on quarter thanks to the low base. Key ratios, if you watch out, the calculation shows that the net interest margin has declined both YOY and quarter on quarter, and ROA continues to remain below 1%. Asset quality largely stable with respect to gross NP and net NP ratio. Back to you.
All right, thanks a lot for that, Abhishek. In fact, we have the management joining us at 10:15 a.m. to discuss their Q4 earnings. So stay tuned to that conversation of IDFC First Bank. Mr. Vaidyanathan will be joining in here on CNBC TV18. Well, today the big numbers that I'm going to be looking at is going to be Ultratech Cement from the cement pack, but we have one of their, the companies that they own, which is India Cements, that came out with its set of numbers over the weekend. And it seems in the first quarter of them taking charge itself, they've tried to make some kind of difference. On the top line, there was only a 3% degrowth. We were getting used to seeing higher degrowth numbers coming in from India Cements. And the EBITDA number is still a net loss, but the EBITDA loss has come down to just 3 crores. So that turnaround strategy is something that we'll be focusing on. Expect the stock to open up in the green because it's corrected 25% from that open offer price. And now it trades at around $80 per ton on an EV per ton basis. The net debt has come down to around 1,000 crores or thereabouts on a year-on-year basis. That's sharply lower. And they'll also benefit from the price hikes that have been taken in South India. So we can expect an improved performance coming in Q1 FY26. So put all this together, going with green on India Cements. That said, let's do a quick recap of all the top stocks which has covered. The ones with positive news flow include Reliance, Mahindra & Mahindra, IGL, Zensar Tech, Poonawalla FinCorp and India Cements. While the stocks with negative news flow include SML Isuzu, LNT Finance, Tata Tech and IDFC First Bank. That's about the equity markets. Let's turn our attention to the commodity pack. We have Manisha who joins us as always to tell us what's going on there. Morning, Manisha.
Morning, Nigel. Thank you for that. I'll start with the gold prices because we've seen further decline coming in. For this one, remember, Friday was a 2% of a decline. And now from the all-time highs of $3,500 an ounce, the gold prices have come off by nearly 6%. Well, there has been rebound in the US dollar index. There are also potential partial exemptions and tariffs, perhaps between US and China. And the markets do believe that the global trade tensions in some sense may be easing as US continues to negotiate with various countries. And that's led to that long-awaited profit-taking in case of the gold prices. The one thing that really seems to be getting support right now is the crude oil prices. They have been inching up in Asia, trading flat to slightly marginally on the higher side right now. Well, the markets are reacting to China Politburo meeting, which is vowed to stabilize jobs, increase insurance funds, etc. And then the markets also are reacting to the Iran port of Bandar Abbas explosion. The street will watch out for the OPEC and allies meeting. Remember, they are increasing production from the 5th of May. And there is a meeting on 5th of May as well, which will decide on what happens from the month of June in sense of output from OPEC and allies. So it's going to be an interesting next couple of weeks, especially for the crude oil prices.
All right, Manisha, thank you very much for that. So, oil in focus as well. Now, Maruti reported a weak set of numbers for the fourth quarter. EBITDA fell about 9%, net profits fell 4.3%. Those comments from Mr. R.C. Bhargav, chairman in Maruti, really made headlines, essentially talking about FY26 domestic growth unlikely to be better than FY25. And of course, there were also comments about effective purchasing power, in terms of consumers in India and how that needs to sort of grow for sustainable growth. I mean, slightly macro-ish comments which made the headlines, but this is, of course, what he told us earlier. Listen in.
The projections made by SIAM on the auto industry for 25-26 do not show a better picture than 24-25. Last year, we grew at about 3%. The forecast made by SIAM is 1 to 2%. So the domestic demand is not growing beyond what it has been in the past, maybe falling a little bit. Where we see a silver lining is that our exports are going to grow. We grew exports at 17% last year. We expect that exports this year may grow at about 20% this year. So that is going to make up a lot of what may or may not happen.
Okay, that's Mr. Bhargava talking about the road ahead for Maruti. We have to take a very quick break. Come back on the other side. We'll be in conversation with Prakash Diwan and get you some fundamental analysis on the stocks in focus today. Welcome back. Reliance Industries. Let's get to the analysis on the big giant. Came out with numbers, of course, after market hours on Friday. We have a whole panel of experts joining in. The numbers are fairly steady. Fourth quarter performance quite all right across all the key segments. The revenues was up about 9%, driven by strong growth in digital services, and retail recovered rather well. To discuss this, we have Gaurav Malhotra, Executive Director, Axis Capital, joining in. He tracks the telecom space. We have Karan Taurani joining in to size up retail operations and how Q4 was for Reliance. And, of course, we have Prabal Sen, who tracks the energy space at ICICI Securities, joining in. And, of course, Karan is from LRI. And we have Prakash Diwan right here as well to discuss Reliance and other stocks. Gentlemen, good morning and good Monday to all of you. Let me first start with telecom, Gaurav, because that's where I think the quibble is that, yes, ARPU has gone up. I think it's gone up to 206, but maybe the street had a little more in mind. But overall, how would you look at it, and what's the sustainable expectation now that the first round of tariff hikes is behind us? What are you penciling in from Reliance's telecom business this year?
Yeah, hi, good morning, everyone. So, see, in terms of ARPU is actually slightly ahead of our estimates. Do know that this is a quarter in which there are 2 less days. So, even if on a like-to-like basis, the ARPU would have sort of dipped, say, 2%, give or take, and the ARPU is up like 1.5%. So, from that perspective, the ARPU has actually moved up, right? And it has moved up on the back of 2 reasons. One is that there has been some residual tariff hike benefit, and secondly, there seems to be increasing data consumption, which is also helping, the company from an ARPU uplift perspective. Now, in terms of how do we sort of think about ARPU moving ahead? See, end of the day, there will be more hikes, right? So we are expecting a hike somewhere in the next 1.5 to 2 years from the last hike. So the last hike happened in June of last year. So roughly, say December 25 to say June 26 is when we expect a hike, and on a compounded basis, we expect that the ARPU of say Jio should probably increase by 8 to 9% over the next say 3 years, and there will also be benefit of subscriber addition. So on the whole, we do expect a healthy top line growth for Jio in the coming 2 years.
All right. Hi, Gaurav, and gentlemen, thanks a lot for joining in. Gaurav, since we're talking about the ARPU and the telecom sector, the segment for Reliance,
Are you factoring in the IPO sometime during this year? And what kind of value are you ascribing to this part of their business?
Yeah, so it's difficult to give timelines on IPO. We don't have much information, right? The only thing we know is that a fundraise with external investors has happened in 2020. So it's been 5 years since that. So difficult to give a time on the IPO perspective. In terms of the valuation, see, from an EV perspective, our EV is roughly around $125 billion for Jio, which is roughly valuing it at like 13 times March 27 EBITDA multiple. This is roughly in line with what we ascribe to Bharti India.
Okay, all right. Got that point, Gaurav. Thanks for that. Let me come to Prabal to size up the energy business. Prabal, good to have you on the panel this morning. We'll talk oil and gas, E&P, all of that. But what was interesting that I noted was that brokers now have started ascribing value to the new energy business. I think I read a Motilal note. I think they're factoring in about 75 rupees from this piece. But you tell us, how did things fare? E&P was a little below estimates on volumes, KGD6 volumes, like we said. But what was your takeaway and how much value are you giving to new energy right now?
Yeah, to answer your last question first, new energy, I think people have been valuing at a multiple of capital employed. I think what will probably change is as visibility continues to emerge in terms of the timelines of completion of some of these plans. All of us will probably start to sort of build in specific tangible numbers coming through from the segment. So the valuations will probably see a rejig up or down. We don't know at this point of time. But as far as we are concerned, we are valuing it at about 1.5 times the initial capital investment that was announced of 750 billion rupees, which translates to, I think, something like 50 to 60 rupees a share. So that's something that is there in our SOP. That's one. As far as the first part of your question in terms of how the energy business performed, I think in terms of KG-V6 performance, yes, probably the production was a bit lower than expectations. But to be fair, the management had already, always maintained that these were not exactly new fields. These were essentially satellite fields. These were standard fields that they had basically developed to, sort of increase production from KG. So they were always going to have a relatively lower shelf life in terms of a peak period as well as a plateau period. So some decline, I think, was to be expected. If I look at the commentary that was made, I think they are looking to sort of stem this decline to the extent that they can. How successful they are, I think, is going to be seen over the next couple of years. But, obviously, I don't think that they realistically upstream can actually show any huge growth in the near to medium. I think the OTC segment business is where I think the attention needs to be probably be there, given the kind of uncertainty that we're seeing, in terms of the global margin environment. The management themselves were very clear to point out that petrochemical margins are near a decade lows across certain key commodities. And I think that is something that remains a bit of a worry. That from this base, while there is capacity expansion now that is there on the anvil by FY28, that should sort of commission and start to contribute. From a margin perspective, I think that remains a key monitorable. When do we actually see any recovery, both in the refining and petchem part of the OTC business? I think that is something that remains a bit of a worry for us.
And what's the timeline of recovery that you're factoring in, Prabal, given where oil prices are and, where demand seems to be?
I really think that from a demand perspective, I think refining is not doing that badly. Petchem, there is a little bit still of oversupply. So, I would expect recovery probably in refining slightly ahead of what happens to petrochemical. But just to be specific to Reliance, I think what they have done well is they continue to sort of diversify and, be flexible between the kind of several multiple inputs that they use in the petrochemical business. As you know, they have a substantial amount of ethane-based capacity. They have an ROGC-based capacity, and then they have internal naphtha-based capacity. So, beg your pardon. If they are already trying to source much more ethane for the expanded capacity that they will have on stream. And I think even within the existing part, the ethane pricing benefit is something that has actually kept them afloat. If you look at some of the trends that were there in margins, the fact that Reliance has still managed to deliver 150 billion in EBITDA, I think it's a function of the fact that they have a diversified and a very flexible sourcing mix, rather than any huge change that has happened in pricing per se. I think that will probably continue.
Okay, all right. Let's address the other part then. Karan Thorani as well as with us. Hi, Karan. Always good to see you in. Let's hear your thoughts then. The retail part of the business was a bit of a worry. But in the past quarter, that seems to have grown quite well. And it's laid a solid foundation for growth in FY26 as well. What was your reading in terms of the performance in the past quarter? And what are you penciling in terms of a path ahead?
Hi, Nigel. Good morning. I think if you look at the retail business, I think the performance was slightly disappointing. Majorly on two counts. I think this is in line with expectations as well, largely. Reliance, as you know, is a large conglomerate. They operate more than about 19,000 stores. They have been kind of rationalizing their store growth. If you look at the net store addition this quarter around, it was extremely low. If you look at the last 7 to 8 quarters trend, the net store addition has been kind of coming off. So this could be, concerns relating to the digital businesses. So if you look at the grocery business, we have seen disruption that side because of quick commerce. If you look at the beauty personal care category, even that is moving very aggressively, towards the online segment. So I think putting these things into perspective, they would have kind of, curtailed the stores. Every segment is seeing increased competitive intensity. The apparel category, the fast fashion segment, all these segments are seeing increased competitive intensity. And maybe that's why they're trying to rejig their portfolio, curtail the stores. And this may be a near-term thing, right? I mean, it's going on in the last 4 to 6 quarters. But the big question mark is, how long does this last for? Is it for another 4 quarters, 6 quarters, 8 quarters? What exactly are the plans in terms of store rationalization? Because unless the stores don't move up in terms of growth, you will basically not see, the overall growth coming back for Reliance Retail. So if you look at Reliance Retail as a portfolio, overall growth was in the range of 15 to 18%, which has now come to almost about 3 to 4%. So I think store growth is very important to come back, and how they kind of execute that, what are the plans there, that's a very big monitorable. Second monitorable is around the digital businesses, right? So I mean, all these businesses, whether you call it electronics, the FMCG, beauty, personal care, because of quick commerce, e-commerce, there's a lot of disruption there, and there is extremely high growth on a digital part. Offline is kind of struggling because of footfalls, and also because of increased competitive intensity between D2C brands and many players coming in the market today. So I think how Reliance executes their digital business plans, that's also one very big monitorable, because if you look at the contribution in terms of digital businesses for Reliance Retail as a company, it's been range of 17 to 18% for the last 8-10 quarters. So no doubt, I mean, the contribution has remained stagnant, but it's not grown, beyond the point. So they have to really scale up digital businesses, which will come on the back of better execution, maybe better assortment, or, they're trying to rejig their strategy, doing JioMart 30-minute delivery. They're trying to launch Shein as well. So how they execute these online businesses is going to be a key monitor in terms of how growth pans out for Reliance Retail as well, apart from store expansion coming back on track.
Okay. All right, gentlemen, thank you very much for a very comprehensive 360-degree perspective on Reliance, all of its businesses. Very, very helpful this morning. Thank you for weighing in. So now let's quickly go to Prakash, if we can. Prakash, we have lots to discuss, but quick, 30 seconds on Reliance. All the analysis, everything put together. What's the call on the stock?
If you were to accord a 10 lakh crore EV value to Jio platforms, to retail, and all the O2C, O2G, and of course the new energy business, it kind of lands up at about, close to about 27 lakh crores of market cap, which is a significant move from where it is in the next 2 years. So, my math is pretty clear. The SOTP is extremely favorable. Quarter on quarter is difficult to analyze Reliance, but from a long-term trajectory that it's kind of aiming for, it's going to be exciting. Probably one of the best large-cap stocks that's available at the current juncture. So quite enthused with these numbers. And of course, we'll wait for the EGM commentary to kind of consolidate or validate these expectations.
All right, fair enough. That's all of Reliance. We'll take a quick break on that note. Come back, more stocks to discuss, more fundamental analysis as well as technical. Sudarshan Sakhani and Mitesh Thakkar joining in with today's trading setup.
Welcome back. There's 8 minutes to go for the pre-open session to kick off. Flashes at the bottom of the screen. It looks like it's meaningful. Sonata Software has bagged a 5-year contract worth 73 crores from a US technology, media and telecom sector company. So for a company the size of Sonata, that's a It's a pretty meaningful, large contract which is coming through. We'll try and connect with the management a little later in the day. Sudarshan and Mitesh are with us for now with what they'd want you to do in terms of trades. Gentlemen, good morning. Good to have both of you here. Sudarshan, you go first. What's the picture looking like? How are we set up in this fresh new week?
The last 3 days we were choppy and sideways and in a narrow range. My suggestion then was do not trade. Luckily, today is a very different day. We have gone through a deep correction and that is probably behind us. So I would be a buyer today. Now, when to buy is a question of tactics. Each trader may have a different view or a method, but you could buy on an early morning dip. You could buy partly on a gap up, even if it's a gap up, and then add to your positions. Also remember that if you are taking this week's options, the options will expire on Wednesday, not Thursday. So you have only 3 days of risk and the markets could do nice things. So be a buyer today.
All right, buy the dip. That's the call from Sudarshan. Got it. Gentlemen, good morning to both of you. Mitesh, what about you? What would your approach be today?
Good morning. So, I think on Friday we highlighted 23,900-870 as the probable support area. We got a low of around 23,850. I think this is a zone where, important support levels kick in. And as long as we are not breaking below that, I think this could be a market which could do 24,500 on the upside as a range and 23,850, 900 on the downside. So I think we are in for some consolidation in the next few days. But with what Sudarshan said, I think it's important to note that around these levels, today could be a day to buy because you're now trading at the lower end of the range. So this could be a good level to buy. But I would be slightly nimble given the fact that I'm expecting some consolidation. I think if you get profits on a 1-2 day kind of a basis, be fast to book them at least 50%. And around 24,500, I think exit and then wait if there is a chance of breaking beyond that. So for the timing, I think there's a consolidation going on. But purely from today's point of view, I'll be on the long side.
Okay. All right. Got that. What about individual stocks? What are you trading today, Mitesh?
I have all buy calls. SBI Life is a buy with a stop below 1680 for targets of 1740. Adani Ports has come down to support areas. So buy here with a stop below 1172 for targets of 1245. Similarly, a buy on Power Finance Corporation with a stop at 407 for a target of 430. And Emphasis is a buy. Keep a stop at 2515, look for targets of 2590.
Sudarshan, what about you? What would you trade?
Well, I have 3 buy calls and 1 intraday short. And the short is mainly to temper the optimism. Markets can do anything. So the short is IGL, Indraprasth Gas, and we know what is happening there in that sector. It's an intraday short with a stop above 183. Reliance comes in my buy list after a long time. Reliance is a buy, and as usual, once Reliance is a buy, it's not just an intraday trade, it's also a positional buy. So Reliance is a positional buy, intraday buy with a stop under 1282. Grasim is another stock, it's coming in the same group, positional intraday buy with a stop under 2675. And the third one is Chambal Fertilizers, which is making new highs in this market. Again, it's an intraday buy and a positional buy. So there are 3 positional buying opportunities. Chambal is a buy to stop under 660.
All right, gentlemen, thank you very much, both of you, for joining in with those specific trading ideas. What we'll do is we'll, of course, come back to you at about 9:10 with new calls. Pre-open is about 4 minutes out. We're going to come back with the management of Dr. Lal Path Labs on their 4th quarter earnings. Stay tuned.
Welcome back. Lots of other stocks to go over and earnings to go over as well. Prakash, let me ask you about Shriram Finance. Let's pull up the stock. I mean, Shriram ended down quite sharply on Friday itself. The numbers that were trickling in just as the market was closing out. And it seems this rise in credit cost and the whole asset quality issue, that's not going down too well with the market. But your thoughts on what you made of the numbers?
So the numbers have not been very encouraging, not the best set that you would expect from Shriram. But look at this in comparison to a lot of the other NBFCs. I mean, you may have a Poonawalla that's shown AUM growth, but it's at the cost of probably quality or even margins. You look at M&M, definitely disappointing. So I think the NBFCs are still facing the heat in terms of cost of funds. Whereas it's the banks that have actually gone ahead and taken advantage of the softness that they enjoy in terms of CASA and whatever. So I was very impressed by DCB numbers. Of course, it's a very small bank, doesn't really move the needle much for most portfolios. But, NIMs are, NII is at 20% kind of growth from a last year basis, or even from that perspective, the credit quality improvements. These are distinct changes that are happening. So I would still stick with the banks, Sudeep. I don't think NBFCs yet have a place under the sun, as long as the banks are offering you a much better proposition from the next couple of quarters perspective.
Absolutely. And just a reminder, the stock closed off 8%. Shriram Finance on Friday. Pre-open rates will hit us in the next 1 or 2 minutes. Let's see. But brokerages have really downgraded estimates across the board.
Absolutely. And but stock's done phenomenally well. I think second largest NBFC still. I think, and of course, Chola, Shriram both reporting numbers back to back on Friday, and we have the managements back to back this morning as well. 9:40 and 9:50 is what you will hear from both companies in terms of guidance, etc. Dr. Lal, Pathlabs is the company that we want to focus on. Fourth quarter numbers in focus. We have. We'll talk about the environment and, of course, SwasthFit, which is such a big focus area, bundle testing, basically. We have Shankar Banerjee, CEO of the company, now joining in. Mr. Banerjee, good morning. Good to have you with us here. Prashant, this side. Could you, so we have a kind of guidance for FY26 as well. So could you just sort of break that up for our viewers? It's only slightly better than what you've actually ended up FY25 with on the top line front. Is it still all going to be volume-led? How is pricing environment looking?
Right. I think the guidance we are giving is slightly better than what we did this year. So maybe 11% around or slightly better than that. You see, we've mentioned this before. Volume can be measured in terms of patient visits as well as sample growth. So even in this quarter and for the full year, our sample volume growth has been about 9.5%. Whereas our overall top line has been at a 10.5%. So it is a lot of volume driven growth because we hadn't taken any price increases in the previous financial year. Going forward also, the focus would be to see how we can keep, the sample volume growth high. And we are also working on to improve the patient visit numbers. So yeah, the focus on volume will remain.
Right. Hi, Mr. Banerjee. Good morning and good to see you. And you all have also been talking about focuses on tier 3 cities, right? If you could tell us where you see this number headed, what is the focal point out there? And what is the difference if you compare tier 1 with tier 3? What is the pricing difference between the two?
So tier 3 cities for us is an ongoing, expansion project. And even, this financial year or the year that went by, we've grown at mid-teens kind of numbers in the tier 3 plus. Our focus in the tier 3, tier 4 cities is primarily in our core geographies of north and east. And, pricing isn't so different. Pricing is more or less same for the given geography. So the urban, semi-urban and the tier 3, tier 4 in a given compact geography, we would operate at similar pricing. So we don't really have any serious pricing differential between, the tier of cities.
Mr. Banerjee, what about margins? FY25 margins at slightly over 28%.
Yeah.
What can we expect in 26?
So 26, we are guiding around 27%. We would like to be investing, into new infrastructure. So we've opened 18 new labs last financial year, and we are looking to open again 15 to 20 new labs in this financial year. Also looking at strengthening our field force, spending on technology. So there are a lot of other investments that we intend to do. So we would be looking at about 27% kind of EBITDA margins.
Which will translate into an EBITDA per patient of roughly around 240, 250, because that was the pleasant surprise that we saw in the past quarter. The street was at roughly around 230. You came in at around 249, I think, or thereabouts. So that should be the rough number.
We really don't, track the EBITDA per patient kind of a number. I think, overall, I mean, that's a derived number which one can look at, but that's not a metric.
We'll focus on the margins then. We'll focus on the margins, Mr. Banerjee. All right. Let's focus on the other big aspect. You're sitting on a good amount of cash in your books, close to 1,100 crores odd. And you all have mentioned in the past, inorganic growth is something that you will look at. Have you all zeroed down on anything? Something we could hear in the next couple of quarters? Maybe the geography, maybe the expertise or the area of specialization? If you could give us a sneak peek.
Yeah, so, using M&A as a tool to expand our geographic reach, specifically in the markets of South, where we are relatively weak in terms of presence, and also maybe parts of West. So we continue to look for opportunities which can, give us a platform on which we can then maybe grow the business. So that's something which we are continually looking at. And the cash on books is primarily there to help, close any deal as and when that is ready. As of now, there isn't anything that, we can report right now. But the discussions or, the search and internal discussions on that continue. And we are hopeful that, there should be something which we should be able to come up with.
This, and what about, could it be in tier 3, since that has been the focal point? I think it's around 35% of your mix as of now. You could correct me on the tier 3 exposure. And the inorganic growth could be in that direction?
So tier 3 is a lot in our core geographies. So tier 3, tier 4 expansion is actually in our core geographies of North and East. Okay. However, for our M&A opportunity, we would like to build our access in some of our underrepresented markets with low brand strength, specifically in markets in South, maybe parts of West. So it is unlikely to be tier 3, but we don't foreclose any options. But, the focus would still be on South and West when we are looking at M&A kind of opportunities.
Final question before we let you go. Swashvit, that's around 26% of the mix. You all have indicated in the past that will scale up a little bit, 30-40%. For this year, what kind of a number should we work with, and by when do you get to your goal?
So this year we've closed not at 26%. We are done at the quarter was about 25%, but if you look annualized, we did about 24%. 24%. Swashvit contribution. And, every year the contribution is increasing by about 2 percentage points or 2.5 percentage points. We would like to see that trajectory, and there are still, geographies and, town classes where we can penetrate further. So we believe, and even I think the market is seeing a lot of appetite for bundle testing. So we believe that even this financial year, we should be able to keep that trajectory going.
Mr. Banerjee, we wish you all the best of luck. Thank you very much for F526 and beyond as you and your team continue to execute. Thank you. So that's Dr. Lal with focus on the business and some numbers, few forward-looking numbers as well. We've seen the worst of the Trump tariff dip. That's essentially the word which came in from Ramdev Agarwal of Motilal Oswal Financial Services. We spoke with him on the sidelines, of course, of the numbers that they reported for the fourth quarter. So just want to play out a quick snippet of that bite. Focus on markets. Listen.
I think we are just about getting over this Trump tariff risk, which was kind of hogging the limelights in last 1 month or so. So that portion is, my sense is that we have seen the worst of that, globally also and locally also. So I don't think market is going to be scared second time out of the tariffs. You can't take the global markets or local markets lower than whatever we have seen in last 1 month because of tariff. Now this new issue of Indo-Pak has come up, this Pahalgam, which is very serious, and one will remain cautious because this brings a very different kind of India localized kind of a risk factor, and how things will move, we have to be at the guard and be cautious on that. I think India is standing out as a shining star in the global framework, in the sense that I was meeting few FIs. They are saying that they're underweight America, they're underweight China. So I said, where is overweight? So they said Europe and India. So I think India is standing out very clearly. And if you see the last 10-15 days flow, that clearly shows that which way the wind is blowing as far as FI's attitude is concerned. But let's see. I think in this year, 25-26 will be Indian markets for FIIs. They'll come big time. Things are peaceful because now credit flow is coming. The tax benefits are going to flow in. The regulators are talking about growth. So I think everything is positive for this thing. And in this kind of environment, and particularly it's a corrected market. I mean, 25-26 at index level, it's just about 6-7% up. So we have a fully corrected market. 25-26 should be more like 18-20% kind of thing.
Okay, that was Mr. Ramdev Agrawal on the market and the way forward. Back to our technical experts for the 9-10 calls. Sudarshan, what stock would you go with?
Well, Chambal Fertilizers, consider buying Chambal Fertilizers with a stop under 660.
Chambal, okay, got that. And Mitesh, what's your stock?
Buy on SBI Life for targets of 1740.
Just one, SBI Life is that name. Of course, numbers were super strong and the stock was higher, and then as the market was correcting, it came off because of the market, but otherwise it was very strong. Mitesh, the big winner of last week were technology and IT stocks. Tata Elxsi was up 14%, Coforge was up 12%, Tech Mahindra 12%, Emphasis 12%. Anything stands out for you?
I think two strong stocks, which appear very interesting to me are HCL Tech, which I would recommend buying with a stop below levels of 1530. For a target of around 1620, possibly even 1670. And Tata Elxsi, you already mentioned that. I think that's another stock with a big reversal. And then on Friday, it gave a strong pullback, giving you a good risk-reward entry equation from here. I would look at a target of around 5900 over here and recommend a buy with a 100-point kind of stock.
Just two more names. Vari was up 15% last week. I mean, enough price history for a call here. And Blue Star sold off 14% last week.
Why I'm not tracking Prashant also is the fact that the price history is also well limited. Blue Star is something, yes, on my radar, and it is some kind of breakdown which has happened on the weekly charts. Though I think there's a monthly pivot around these levels of 1690, 1660. If it starts breaking below that, I think the stock can go into a big correction and even look at a period kind of a target. So keep 1660 in mind, 1660, 1690 zone in mind, and as long as the stock is above that, hold on to it, but I think that should be a trading stop loss. But reversal would only happen if the stock starts getting past 1850.
Okay. All right, got it. Gentlemen, thank you very much for that. It's about 9:11. Markets consolidating. By the way, along with Shriram Finance, also watch out for LNT Finance today. Both of these stocks are down after numbers. On to Sudarshan then, M&M and SML Isuzu. So the SML shares in pre-open are down 5%. That's because of the open offer price, lower than current market price?
That's correct. So as far as M&M is concerned, it's a good deal for SML because open offer is going to be made at a price which is at a discount of almost 12% to Friday's closing price. Open offer to acquire 26% stake by M&M is going to be done at rupees 1,555 per share, and the company is acquiring nearly 59% stake from promoter Sumitomo and Isuzu Motors, that is the public shareholder, total nearly 59% stake at a rupees of 650 per share. Company is expecting to complete the deal by December end, and it's an all-cash deal. And the objective of M&M to acquire this SML Isuzu is to expand its truck and bus segment, and in the capacity of more than 3.5 ton commercial vehicle. Currently, its market share is 3%. It's looking to expand to 6% post the acquisition, and by FY36, it's looking to increase the market share in the range of 20-20%. So overall, it's very positive for M&M, but as far as SML is concerned, in pre-opening move, it's indicating that it's not a great deal for SML Isuzu.
Okay, all right. Thanks a lot for that, Sudarshan. Well, let's hop across to Rima. She's here to tell us about Oracle. Rima?
Well, three reasons why Oracle in pre-open is higher. One, Big margin and profit beat. While the top line of the company was flat, margins expanded by 300 basis points to 44.6%, and profits were up 18 to 19%. So that's reason number one. Secondly, the stock has already tumbled 32% down on a year-to-date basis. And the third reason is the company has declared an interim dividend of 265 rupees per share, which is the highest dividend declared by them in the last 10 years. Back to you.
All right. Okay, that's Oracle coming through at this point in time. You know, I just want to quickly take a look at, there's about 2 minutes to go for the market open. Maybe we can look at these microfinance companies as well. You know, the news flow out of Tamil Nadu once again perhaps will have an impact. Maybe look at Credit Access, Ujjivan Small Finance Bank, and others as well, and just see if there is any impact at all. Credit Access perhaps will, nothing at all actually this morning in terms of the MFI stocks. Or okay, 4% lower on Credit Access in the pre-open. So there is something, of course, that's a big one which always is in focus for one reason or the other, industry or company-specific news flow. But help from Tamil Nadu government in terms of a draft which is being proposed to, you know, protect borrowers against coercive kind of recovery processes from lenders. So that's the news flow. And I think we saw something similar in Karnataka. And we are now starting to hear of this in Tamil Nadu as well. So what do we have? The first rates as they start to come up, it's going to be very, very stock specific because there is enough and more to move names. And we will sort of course track what comes up there as we go along. The open on the indices as the pre-open has left us is kind of mixed. Small cap is down, Nifty is up, Nifty Bank is flat. So what do we have? It is 24,088 on the Nifty, about 0.12, 0.1%, so nothing on it at all. The Nifty Bank is, again, got nothing on it, 54,624 or so, so just blinking red and green. The Nifty is now picking up a little bit, about 0.25% higher. We've got the mid-cap index up about 0.25%, and I think the small-cap index is absolutely flat to begin this session. 640 stocks are higher, about 1,000 stocks are lower, but this is the very first minute of the market open. Heat map, perhaps, if we have it, just quickly gives you a view of how things are looking. It's mostly in the green, but you got about 14, 15 names which are in the red. Reliance is at the bottom of the screen. There's a 2% pop. Surbhi.
Yeah, Reliance is up and about, but look at Shriram Finance, another 8% down after an 8% tumble on Friday. These large NBFCs, it's a rare disappointment of such magnitude. Remember, credit cost is much higher than the street estimated. There's pressure on margins, and there seems to be a bit of an NPA concern building up as well. So that's the big result casualty. But out of the Nifty, the other major one is LNT Finance. Don't take your eye off on that because LNT also started 8% down on LNT Finance, 8% down on Shriram Finance. Same situation with LNT as well. There's pressure on margins, and the gross NPAs have inched up slightly, and the street just doesn't want to have any of it. So there are your result disappointments for the morning. But otherwise, the market's holding up. So let's go back to the green side. Reliance is still in leadership position, 1.5% up on the stock. M&M is reacting well to the news of the purchase of SML Isuzu, 1% higher. Actually, since I'm talking about the deal, let me check SML as well. SML is down 9%. It's very quickly correcting that arbitrage. Remember, so just told us the closing on Friday was 12% higher than where the open offer price is. Open offer is coming in at 1,555 crores, roughly 54 crores, 55 crores. So it's very quickly correcting that arbitrage. Anyway, other large stocks that are moving higher, Dr. Reddy's, Eternal, IndusInd Bank, BEL, these are your other gainers, SBI and Axis Bank. The banks are looking good. SBI Life is continuing its good form from last week as well, 0.5% higher. There's some gain on names like Hindalco as well, LNT. So otherwise, the Nifty is fine. And lots of other large cap stocks making up for the disappointment. But these are the names that are on the downside. HCL Tech is slightly lower, 1.5% down. Today is a day of big headline stock moves, really. Nifty otherwise is fine. 100 points up to begin with. Nigel.
All right, few stocks that are on the radar. RK Forgings, they've uncovered some discrepancies in inventory that could dent the company's net worth by around 4 to around 5%. So RK Forgings actually is a stock that's got a hard knock this morning. I think the stock should come up for you on the screen. Tejas Networks, that's the other one that's losing out in trade. There were a couple of one-offs in those numbers, mind you. But for the time being, the street has just looked at the absolute margin number, and that's the reason why that stock is down closer around 10%, though it's recovered in the last few minutes from the low point of the day. Pull up Ramkrishna Forgings. I think that as well should come up for you on the screen because of those, those discrepancies in the inventory. Motilal Oswal continues to see some selling. Remember, Friday's trading session, it came out with its set of numbers, but the stock was under pressure. Mr. Ramdeo did clarify on that, but for the time being, another 4% lower. Industars, that's a stock that's opened up higher because they'll be considering, a buyback at their board meeting on April 30th. So on the back of that, that stock is doing well. Stocks that are really doing well from the banking pack, DCB Bank and RBL Bank, both of them flying away in today's trading session. So the start is pretty okay for the Nifty. You have SML Isuzu. Those that were buying for the deal, they seem not too happy about the deal because the pricing is something that's hurt. And, Mahindra's got a good deal. But for shareholders of SML Isuzu, not too great. Stock down 10%.
The stock had already rallied this year. Yeah. SML, in anticipation of this deal and how many suitors are quoting it, is up 20% in 2025 when the Nifty is absolutely flat. So it's perhaps in the price. And then this is a formula-based thing, with the open offer pricing. And I guess that final formula price, now the stock's very quickly moving towards that, which is 15.54.
RK Forging, I mean, I don't know if you've put up the
I just mentioned.
Okay. So the stock maybe. So that there's a release which has been, and I think there's a call at 11 o'clock as well. So there is an inventory mismatch which has been reported. A release to the exchanges says that the promoters will make good the difference by permissible instruments, etc. So keep an eye out on this one. I mean, it just came to my notice because last week it was a top loser. One of the top losers, when I looked at the NSE 500 list, it was down about 12%. Friday to Friday, this morning is down about 5%. And now we've got some clarification coming through as well on RK Forging. All right, well, what else do we have? Dixon is up 2.5%. It's got... is it that Apple news flow? Although Dixon doesn't work with Apple, but it's got the entire Android ecosystem on it. Indus Tower about 2.5 higher. Blue Star, I was talking about this with Mitesh earlier. Blue Star lost 14% last week. It's coming up with about 3.5% pop. There is Kalyan Jewelers, which is up about 2.25%. Actually, almost 3% on Kalyan Jewelers this morning. There is Kim's, the hospital company, which is up 4.5%. 704 on that one. Torrent Pharma is up 2%. PG Electroplast is up about 2.5%. And so it goes. But volumes are, I mean, limited. If you just sort of go beyond the first 10, 12 names, as is the case most of the times. But it's all, Shriram Finance and IDFC First is down about 2.25% as well. Chola Finance is down 3%. Poonawalla FinCorp is down 3%. Lal Path Labs, we just spoke with the company, is down about 4% as well this morning. So, that's the overall picture. Market breadth is flipping a little bit on the downside. So keep an eye. 1,400 stocks down, about 850 stocks which are higher. Pratik Gupta is with us, CEO and co-head at Kotak Institutional Equities. Pratik, good morning. Good to have you with us here. As of last Friday's close, Nifty is India's the best performing large Asian market from the Trump Liberation Day tariff announcements from the close of 2nd of April. We've crept back into the positive territory, YTD. We just played out sound bites of Ramdeo Agarwal, who was telling us that in his interaction with foreigners, what he's hearing is that, global mutual funds, foreign investors, etc., are underweight the US and the positive Europe and India. I mean, that's the feedback that he got. What are you picking up, just in terms of foreign investor sentiment and from a flows perspective? Because last 8 days, there's some 32,000 crores worth of foreign money which was coming.
Good morning, Prashant. Yes, I would agree with that assessment broadly that foreigners are definitely, especially the non-US investors, the Europeans in particular, for example, they're looking at India or looking to firstly get out of the US, trim their holdings in the US, and some of that money is finding its way back into markets like India. And even globally from the US, we are seeing some increasing interest from asset allocators to investing in emerging market funds. The number of inquiries has gone up. The passive funds have seen big flows coming into EMs, and India is benefiting as a part of that. Within that, when we speak to our clients globally, we are seeing that a lot of folks were seeing India as sort of the least bad emerging market, meaning that there were issues with other markets, especially China in particular, where despite the cheaper valuations over there, a lot of folks are still worried about the long-term implications of the trade war. Even before the trade war, China was going through a pretty severe slowdown. And now you have the trade war, and who knows how that thing pans out. So despite the cheaper valuations in China and despite the somewhat more expensive valuations in India, we had been through a bit of a market correction in February and even in March. So we had started seeing some interest coming back in. So to that extent, yes, we are an expensive market, but just given the lack of better alternatives, we were beginning to see some money coming back into India. Now, the one change which has happened last week is obviously this terrorist attack in Kashmir, and we don't know how that pans out, how badly it escalates. So that's something which is, I think, once again going to be a little bit of a fly in the ointment for the short term. But I think fundamentally we are moving in the right direction.
Pratik, hi, morning. Good to have you on the show today. So if you're saying we're fundamentally moving in the right direction, if you could sort of give some further indication on that. If we leave aside the tariff issue, for an instance, leave aside what's happening on the security situation, let's just talk earnings, right? Because that's the bread and butter of any market. There, we still hear of several concerns. And I mean, look at the accidents this morning. I mean, NBFC is showing up some asset quality issues here and there. On earnings, what are you penciling in? Because the big worry is that we're not out of the woods as yet, and whether we are going to be seeing more downgrades for FY26 as the year progresses.
So, Surbhi, yes, on the earnings front, we've anyway been conservative for quite some time. And we have, even right now, I believe our estimates would be below the street estimates. At Kotak, we're penciling in about 12% earnings growth in FY26, followed by another 14% in FY27. And you're right. I think we are likely to see more earnings cuts. So maybe that 12% becomes, we end up being 9 or 10%, which would be in line with the nominal GDP growth. But I think what I meant where things are improving is things like, for example, the RBI is becoming a lot more, I guess, they're cutting interest rates given the decline in the inflation level. Liquidity is improving quite dramatically, and RBI is committed to providing more liquidity. The stance has moved to accommodative. And even from a regulatory perspective, RBI is becoming a lot more sort of business friendly and removing some of the onerous regulations. LCR, for example, has been pushed back and diluted. So one is the RBI stance. Second, I would say we've seen about almost a year of government capex being somewhat slow. And you've had a change at the helm in the finance ministry, 4 new secretaries coming in over there. So we think once again, the government capex cycle, which was anyway sort of picking up, will get a fresh, with these fresh faces at the helm. I think you'll start seeing that being pushed through more aggressively. On the currency front and trade war front, Scott Bessent, the US Treasury Secretary, said last week that India and the US are quite close to signing a trade deal. Now, we remain skeptical as to what will be the contours of this trade deal, given that farm products or even 100% retail, 100% FTA and retail is going to be quite difficult for India to agree to. But nonetheless, if they manage to work out something, that would be a pretty big positive. And then not to mention things like a normal monsoon, which should help. And so the point about earnings remains, and which is why we are not bullish on the market, but neither are we saying that we are in an extremely expensive zone. What's keeping us cautious right now is still the valuations. 10 days, 15 days back, we were beginning to get into slightly attractive territory. And the way the rally has happened in the last 10 days, again, we've become sort of more towards the expensive side once again. So again, we're back to being somewhat cautious again.
Okay, all right. Hi, Pratik. Good to hear your thoughts. As always, a little bit cautious with a hint of optimism on select spaces. Let's talk about the changes that you've made in your portfolio. Reliance Industries, that's one of the key reasons that we're holding in the green this morning. And the stock actually had seen a big correction of close to around 20%, and it wasn't holding one end up for the Nifty. But in the last couple of weeks, in fact, it's found its form. You'll have gone ahead and increased your weight out there. Give us the rationale.
So I think the main reason for Reliance has been the improvement in the performance of its retail business, where some store rationalization and pickup in the retail revenues, that's really helped a lot. And not to mention the telecom business is doing well, potential for tariff hikes later this year. And also in the context of the overall market, where we think there will once again be a flight towards large caps. The small mid caps are no longer as attractive as they were perhaps 1-2 years back. So in that context, and also given the decline in global crude oil prices, that also helps. So with all of those considered, plus the strength in the retail business, the outlook for the retail business and the telecom business, given that the core petchem business is chugging along quite well, from a valuation perspective, Reliance is beginning to look attractive compared to the other options you have in the market, say in the consumer discretionary or consumer staples, or even IT services, where the stocks have come off, but there's a pretty sharp earnings downgrades happening over there. So in that context, that's the part of the reason for Reliance is again amongst the least bad alternatives out there within a model portfolio.
That's the problem, right, Prateek? I mean, just to go back to what you said, 10% move and suddenly you're worrying about valuations because there's no help from earnings coming through. If there was a bit of lift from earnings, then you kind of sort of can, it gives you leeway. You can imagine higher multiples, etc., but that is just not there as of now. Do you think it'll be a second half story? It's possible. What's your sense? The RBI is not holding back in terms of helping on liquidity, etc. Maybe you need something, those tax cuts, etc., perhaps will start to come in from May. The impact of it at the margin, I don't know how much though, but can it be a H2 story, earnings?
Prashant, yes, that's what we are banking on. We think it will be a second half story, not just one is obviously earnings. By then, hopefully, the worst of the earnings cuts would have been, we'll probably have a weak March quarter, possibly a weak June quarter as well. And September, December onwards, we start improving on a Q-on-Q basis and on a YOY basis. Projections are for a normal monsoon, so that should help as well. By then, I think the impact of the RBI rate cuts, the better liquidity environment, a more stable rupee, all of these things, and a lower oil price, lower commodity input prices for a lot of the companies, all that will start feeding in. The problem right now is we have a very, very weak demand environment, which has been continuing for the last 2-3 quarters. And as I said earlier on, with the weaker, the lower interest rate environment in India, plus hopefully you'll start seeing government capex picking up more steam, both central government and state capex picking up more steam by second half FY26. All of these things should hopefully start improving the overall earnings trajectory. And the markets, yes, you're right. We're once again back to almost 21 times FY26 earnings. Again, trading at almost a 95% premium to China, for example, to the MSCI EM index. So again, we're back in expensive territory. Most investors globally are sort of frustrated that they missed the boat in the last 2-3 weeks, just when they were sort of getting ready to deploy more capital. A little bit of money comes in and the market just runs away. So a little bit, again, back in the sort of neutral to cautious zone again.
Yeah, all right. Thanks a lot, Prateek, for joining in. Good to hear your thoughts as always. Rational as always. Preferring the large caps. The markets may not be out of the woods and maybe earnings could disappoint on the downside, but optimistic about the second half of the year. Let's get straight to our next management on the show. We have Tata Technologies. The revenue came in a little weaker than expected. EBITDA margins as well did see some bit of improvement. We have with us Mr. Warren Harris, the Managing Director and CEO at Tata Technologies. Hi, Warren. Good morning, and thanks a lot for joining in. Well, how do you see things panning out? The first half of the year could have its share of uncertainties because the globe itself is a bit of a flux. The ER&D space has been having its own challenges. So what are you penciling in terms of the first half of the year? And are you expecting a recovery in the second half?
Yeah, well, we expected about a month ago. We expected a very strong start to the fiscal year. I think the tariff uncertainty has certainly undermined that, and the current visibility that we have is that the first quarter is likely to be soft. But our optimism in terms of the full year is really informed by the fact that a lot of investment decisions were delayed last year. If you look at the United States, there was a lot of uncertainty in terms of who was going to be in the White House. We've seen a lot of regulatory change and incentives for EVs run off in Europe. We expected that situation to be clarified. We were engaged in a lot of really encouraging discussions with our customers leading up to the end of the fiscal year, and we had a lot of optimism. But clearly the tariff situation has confused that, and we're hoping that will provide some we'll get some sort of understanding of how that's going to pull through in the next month or so.
All right, Warren, request you to stay with us. For the time being, we're just hopping across here. Dr. Anish Shah, post Mahindra acquiring stake in SML Isuzu. Let's go there and we go back to Warren.
It was under the scanner of capital allocation 5 years ago, and a business we decided we had a lot of strengths we could turn around. It has done very well over the last 5 years, in line and slightly higher than our expectations as well. We've got a very strong team now and a good product portfolio. Rajesh will talk about the details of the business, and then we'll have Vinod up here as well to answer questions that you may have. But this is a business that we really like and we feel can do a lot, and which is where we got the opportunity of an acquisition which we feel will position us very well, an acquisition which we feel is an appealing one and a very strong strategic fit. So with that, let me invite Rajesh to come up and talk about some of these details.
Thanks, Anish. So we've just announced on Friday evening, as you know, the acquisition opportunity of SML Isuzu, as it's called. We're looking at buying 59% stake of SML at 650 rupees per share. Sorry, the 59% stake includes a stake from Sumitomo and Isuzu both. There will be an open offer that gets triggered based on the regulation, and that will be for up to another 26%. And
we'll cut back, and hear out what Rajesh as well as what Dr. Shah have to say. We'll keep getting you snippets, and keep an eye out on the bottom of your screen. All the most important flashes will be out there. Warren, thanks a lot for waiting by. As you were telling us, the global environment is still a little bit uncertain. But what are you penciling in for the year? I was looking at a JP Morgan note. They are factoring in, single-digit revenue growth with margins staying more or less flattish. Would that be a little bit conservative? Are you optimistic if things recover, you can do better than what they're estimating?
Again, I think a lot will very much depend upon the macroeconomic environment, and again, specifically whether or not we get the type of clarity that I think the markets are looking for in and around tariffs. If we get that, and we get that within the first quarter, I would be very bullish that we can do better than single-digit growth as far as this fiscal year is concerned. Again, a lot of our customers have built up a need to invest over the last 12 to 18 months. And as soon as there's clarity, we believe a lot of that will be discharged, which will provide tailwinds for organizations like ourselves.
An outside chance you even give double-digit revenue growth?
Well, I think we're certainly planning for that. And certainly at the beginning of the year, we were optimistic that that would be the sort of North Star of the achievement that we were looking for. But again, we've got to be very cognizant of the macroeconomic environment and adjust our expectations accordingly.
Warren, hi, good morning. Prashant here. It's a very uncertain world, isn't it? As you began by saying, I mean, companies don't know where they should build. I mean, that's the basic starting point. Whether they should move, not move. So in that sense, I mean, I guess investment decisions take a bit of a backseat. JLR, for example, is an anchor customer for you, about 15% of revenues.
Yeah.
Is this what can you do? I mean, this environment, say, for example, if it stretches through till for the next many quarters till the end of the year. For example, I mean, India is said to be the first in line for a deal, and that is only sometime in the fall when we start to see the outlines of a deal.
Yeah.
So if this uncertainty stretches for the next 2 quarters, what can Tata Tech do internally to mitigate some of the impact, especially on operational efficiency, etc.?
Well, I think you make a very good point, Prashant, about the need for clarity as far as investments are concerned. But I think one of the things that I would say is that the business that we are in, the manufacturing sectors that we are in, they're essentially product-led sectors. And so the automotive industry, for instance, if you're not making investment decisions today, you're compromising or mortgaging your future in 2 to 3 years' time. And a lot of investment has been put on hold in the last 12 to 18 months. And there's a lot of latent demand to deploy that investment and make decisions on products. I think different markets will play out in different ways. We're seeing India being somewhat immune from the tariff play, particularly those manufacturing companies that are focused almost exclusively upon the Indian market. I think Europe is making decisions in terms of interjecting resilience into their supply chain and standing in a position that's less dependent upon the United States, for instance, and the US is very much committed to the repatriation of manufacturing. And so our approach to those markets are going to be calibrated in the context of the specific opportunity that we see. So we're having to be agile, but at the same time, we're hoping for some of the volatility that we've seen in the recent past to settle down.
All right, final word from you, Warren, before we let you go. Since growth is going to be a little bit uncertain, what about on the margin parameter? You have been holding around this 18.5% odd mark. You want to give us a range?
Well, I think our priority first and foremost will be to continue to protect margins. I think we've demonstrated our ability to do that in FY25. I think you've seen also in the fourth quarter the flow through of the contribution of the joint venture that we have with BMW. So net profit and earnings per share has significantly improved. And again, our priority in the first part of the year will be to protect margins. But if we see growth coming through, and we're still confident that will happen, then we will certainly look to improve upon the margins in which we finish the year.
Warren, great speaking with you. Thank you very much. We wish you all the best of luck in this tough, uncertain macro environment. But as you said, a lot of the pending investment decisions also means latent demand when things clear up a little bit. By the way, the market here in India is continuing to chug along very nicely. I think we're at the day's highest point, 24,200. We're up 0.7% at this stage. So some big movers there coming through in a bit from now as well. Cholamandalam Investment Finance is the next company which is on radar. Reported a strong set for the fourth quarter. We have Arul Selvan, President and Chief Financial Officer of the company, to take us through some questions. Sir, good morning. Great to have you with us here. Prashant this side. And a good set. But although I want to start with something slightly on the negative side, which is credit costs, which remain high at about 1.4% in a seasonally strong quarter. Could you give us a sense of what you saw and what we should expect in FY26, sir?
Sure. See, the credit cost had not reduced to the extent it would have reduced in any given Q4, as if you see last year Q3 versus Q4 across products, including vehicle finance. So to that extent, there had been a little bit of a higher cost. Apart from that, what we have also done is the business on fintech, which we have been exiting. We created a certain one-time provision because as we move down and reduce the exposure there, you will have certain hits on the balance portfolio, which is running down. So to that extent, we created incremental provisions. Both these put together has kept the credit cost little elevated. FY26, we should see around 15 to 20 basis points credit cost on a full year basis as compared to current year. That's what we are targeting as we move into FY26.
Mr. Selvan, has stress generally sort of increasing? Is it what is your sense? Also, talk to us a little bit about growth. I mean, AUM growth, I think, has slowed down a little bit if you look at on a quarter-on-quarter basis, especially newer segments, etc. So what's happening?
See, AUM growth in the traditional products continue to be better, especially in the mortgage businesses. In vehicle finance, it has been a little muted considering the slowdown in the auto. But we are moving into other products like used and two-wheeler to keep the vehicle finance AUM, chugging along. New products, yes, there has been a bit of a reshuffle as when we reduce the fintech exposure, we have consciously brought down the exposure there, but that would be compensated by our foray into consumer durables, which we have started. We have been doing Samsung Mobile earlier. Apart from that, we have now started other products also. So that would start picking up to make the new product disbursements and the AUM growth bring back to its old levels. However, overall unsecured, we are holding our target at around 10% of the overall portfolio, so that would not breach that number. But other products will continue to grow.
So 10% is the capping you are putting at, putting for unsecured loans.
Yes.
And overall growth has been really solid, sir. I'm looking at the AUM growth. I mean, you're up almost 27% year on year, 6% quarter on quarter. All segments have done well. But talk to us about your gold plans, because the gold market is where there's a lot of competition. NBFC is fighting to retain their turfs. Banks have been aggressive. The RBI is changing regulation. What are your plans on the gold financing side?
No, like any other product, we would start slow and build it over a period because, as we don't jump in with both legs into the water, we will go slow. We are starting with 100 and odd branches initially. So we are targeting around 1,500 to 2,000 crores in the first year. As we move on and we get comfortable with the product, we will scale it up. As you know, here we cannot leverage the existing branches. We need to create new branches. So we are in the process of creating new branches because the operation structure in the branches are different. So we need to create new branches. We are in the process of doing it. We already started opening branches across east and south region. But we will move slowly. Sorry. Yeah.
Sorry, sir. My question was, we were just trying to understand why you're looking at this avenue. Isn't this already a crowded market? Like I said, so many players, ever-changing regulation, fight for turf. I mean, do you feel that your existing large segments like CV financing, etc., do you see a plateau ahead? Is that why you are opening up the gold avenue? And again, as a percentage of the book, like you mentioned, unsecured won't go beyond 10%. Eventually, say 2 years down the line, as a percentage of the book, where would you want gold to stabilize at?
See, it's not that the other products are slowing down and that's where we are going into gold. Our long-range plan is that Chola will be a complete end-to-end lending institution where we will offer products, especially in the secured side. We will have the full exposure built across all products. Gold is a product where you have better security and a better return. As I know, it is crowded, but there our credibility will come into play as a credible player and a well-known name, and the trust of the customers would come into play. We have seen a large amount of vehicle finance borrowers also doing gold loan. So that is what we are wanting to try and tap into to see that whether we could bring those customers into our fold. We will do it slowly. As of now, I would rather not give a number on the gold because if it pans out well, yes, we can scale it up. But if it does not, we will be slow to learn and pick up, and we will pick up and do it. It is highly regulated. As you know, the recent regulations have come in which are actually in a way good because we start with the new regulations and we do not have to go back on what we have done. So that all these augurs well for us to enter at the right moment with the full regulatory framework in place.
All right, Mr. Selva, and do you think that, other listed players like, say, Manappuram and Muthu, they were having, too easy a ride and there's an ample opportunity out there. So you said, let's go take some part of that pie.
I don't want to say anything of that sort. Yes, there are enough and more in a growing economy like India. In India, I would rather say the unorganized segment is still a large, the bottom of the pyramid, as what we used to project. That's a large segment which is moving into organized segment progressively, and that opportunity with a credible name like Chola can be tapped into and grown. And especially in the rural market where we are strong and our name has been well known, we see that this would be a good opportunity for us to tap into.
All right. And so for the first year, it'll be around 1,500 crores is the target. Is that correct?
I would say so, yes.
All right. Let's get a couple of numbers out of the way then. AUM growth for the year, what should it be looking at? And if you could bifurcate it in terms of segments. And also if you could tell us, what about NIMs? You could get some kind of benefit because the cost of borrowing will go down. So how do you see yields as well as NIMs going ahead?
Yeah, on the AUM first, I will answer that we still target the same 20 to 25% growth as we move into FY26 with all the products, with the mix of all the products coming into play. The mortgage business would certainly have a slightly better improvement as we move into these segments into this year. And on the NIM side, yes, we will see improvement because cost of funds would improve, but it will not be a step change immediately because a large part of our borrowing still is relying on the MCLR change of banks. And if MCLR change, then we will see the step change. Otherwise, the marginal borrowings would be the one where we will see the benefit, but certainly you will see NIMs improving. We will have to share some part of this cost of fund reduction on the floating rate products, which are the mortgage products. But we will see the benefit coming through on vehicle finance where the book is of a fixed rate.
Right. Mr. Selvan, just a quick last clarification before we thank you, sir. On credit cost, when Prashant asked you, you did mention that you're looking at maybe 15 to 20 bips. So that's higher. Could you just tell us FY25? What was the credit cost final number and where do you see it in FY26?
See, we closed the year with around 1.3% on assets on the credit cost, and we think we should do it at around 1 point. We'll close at around 1.2 or lower as we move into FY26.
Your credit cost will go down then, you're saying, from 1.3 to 1.2?
Certainly, our target is to keep it below 1.2 and we should try to do that, yes.
Okay. All right, sir. Thank you very much for joining in for that clarification. Thank you. We'll just correct that flash as well. That's completely clear. From 1.3%, the credit cost for Chola will go down to 1.2% this year. So we'll just rework the numbers on the screen there as well. All right, have to take a very, very quick break on that note. But the discussion with the large lenders continues. Up next, coming up, a conversation with Shriram Finance. Welcome back. As promised, we're continuing a conversation with the earnings analysis for many of the financials. The Shriram Finance stock is still down 8%. And this is after an 8% decline. These numbers, remember, came out just as the market was closing out on Friday. So there's a big slip that's come through. Now, what is the market's concern? There is a large write-off that Shriram did in the quarter gone by. There is some pressure on the margins and some issues around asset quality. So let's clarify all of that and more. We have, of course, our next guest joining in. Thank you, sir, so much for being with us. So, like I said, the market needs a little more clarity on the write-offs that you've taken, your credit cost estimates, and what's really happening with asset quality. So, Mr. Revankar, sir, if you could just start right there. With these write-offs, I mean, the gross NPA level has come down. Are you intending to take more write-offs? And what is the guidance on credit cost? Are you seeing more stress build up?
No, it was a policy decision taken at the board meeting that where we already provided for, we thought for accounts not performing more than 12 months to be written off. So that's a one-off, and I don't think there will be further anything. We just wanted to go forward with those accounts, and the recoveries are still on. It is not that there's no recovery on that. Every quarter we have recovery. And as and when recovery happens, it will become the income part of it.
Sir, can you give some guidance that would help? I mean, what is the kind of recovery, whatever visibility you may have looking at the book right now, say over the next 1 or 2 quarters, and on credit cost as well, I believe it's at 2.42% right now. If you could just clarify, and where do you see this number of 2.42% moving?
See, we have been giving a guidance of around 2% plus or minus 10% on the credit cost. And we are at 2.07 as far as Q4 is concerned. And for the full year, it's around 1.92. So we are within the guidance on the credit cost for the whole asset. And going forward also, next couple of quarters, we don't really see any challenges. The market is good. The rural demand is quite good. And the rural economy is also doing well. So we are quite confident the credit cost will be maintained at the present level.
Mr. Revankar, good morning. Prashant here. Good to see you, sir. Is this increase, though, led by some specific geographies? Could you give us a sense of what we've seen? It's one-off, and maybe some recoveries will happen. But the underlying, is it rural is better, but urban seems to be a little slower? Across companies, commentary. I mean, I'm sure you've heard the Maruti management talk about that 2 days back. We just heard from Chola earlier. So give us a sense, what's happening.
No, overall, the economy is doing quite good. I don't really see any pain anywhere. Some geographies, as you rightly put it, central part of India, there were certain challenges in the rural area. That now the rural markets have improved. I don't think there is any further challenge. It is already addressed. The Rabi crop is supposed to be bumper. It will definitely help the rural credit demand and the rural credit quality to improve further. So I don't really see any challenges. The urban is a little slow because the infra spend has been slow by the government for the last full year. I think the infrastructure projects are coming back, and next financial year we should do well. We expect the demand from both urban and rural to go up, and credit quality to remain stable.
Hi, Mr. Revankar. Good morning and good to see you. Let's focus on the gold portfolio. It's a very small part of your business, but we just had a peer who, was just telling us about his foray, Chola's foray into gold. For you, as a percentage of your book, it's small, but you've seen a degrowth out there. Why is that? And could you tell us what plans you have on this vertical going ahead?
The gold AUM has some degrowth, but if you look at the Q4 disbursements, they were higher by 20% Q on Q. So we are back into gold. We will be growing the book in the next financial year, and we will keep growing. We are also adding more branches to the gold network. It requires certain reskilling and re-engineering the process, which we have already done. So here on, we'll keep growing the gold book.
Okay, all right. So then since you briefly spoke about growth, you are guiding for mid-teens growth. So could you tell us segment-wise what kind of growth are you looking at for the year? And particularly, are there signs that the CV growth is petering out a little bit? Or do you believe that, it's pretty much in fine fettle?
We still believe that CV growth is continuous and it will keep continuing to grow. Maybe between 12 to 15%. Last year also we had given the guidance of 12 to 15%. We grew by 14%. This year too, we believe it will grow in similar lines, even though the sales have been flat, year on year have been flat. And it's mainly because the infra spend coming down, bulk material transportation, which is dependent on CV. And whenever there is a slowdown in steel and cement bulk material transportation, the CV demand comes down. However, we still feel there is a shortage of vehicle on the road, and there is a full utilization of vehicle. The repayments on the vehicles are very good. So we continue to believe that demand will come back into CV, and the used vehicle market will grow faster in the next couple of years because the sufficient number of used vehicles are coming into the market now, because the new vehicle sales started 3 years back and it will come into the market. So we believe overall there will be a growth going forward in the CV. passenger vehicle will grow faster at more than 20%. And of course, MSME gold also will be growing. We will be growing 20% plus. So broadly, I can say that CV and construction equipment will be growing between 10 to 15%. And the MSME, passenger and gold and two-wheeler will grow at 20% plus for the next
overall 15%.
Overall
Mr.
15%, yeah.
Mr. Revankar, on margins, what can we expect, sir?
So margin, we have given the guidance of 8.5. We should go back to 8.5. The last quarter's 8.25 was because of higher liquidity which we are carrying. Let's see, we have been looking for raising long-term resources in the international market. We did have raised certain long-term resources which has a maturity of 7 to 10 years. And since we need to really plan for it, we did raise that money at that time. And that will be utilized in the next quarter. So we will be able to manage our excess liquidity within the control, within the 3 months normally, which we keep. Now it is around 6 months. Next 2 quarters, it should come down to around 8.5 level net interest margin, go up by 8 to 8.5. And we should be able to maintain at 8.5 for the full financial year.
Okay, so margins should recover to 8.5, which is where you were in the third quarter. Q4, it dipped a bit, but you're saying it'll go back to 8.5 and sustain there. Got that point. Sir, on gold loans, just to go back, I mean, you gave us a whole breakup, how you were arriving at the 15% AUM growth expectation for the year. On gold, really, what's going on? We were just discussing this with Mr. Selvan, when one of your peer NBFCs just earlier. They're also getting into gold loans. It's a very exciting market, it seems. But what's the situation on ground? Is there too much competitive intensity? And the RBI obviously is looking at it with hawk-eye. And some sense of the growth. I mean, how do you come back to growth? Will it be Q1, Q2? And for the full year, what do you expect from your gold book?
Now, if you really look at how the gold financing happens, more than 50% of the gold financing, I still believe, is with the pawnbrokers and the unregistered lenders. So there is a huge scope and opportunity because people would like to walk in to nearest place, nearest pawnbroker or jewelry shop for raising money. That's how it happens. So the kind of holding Indians have the gold is one of the highest in the world. So if you are able to plan it well, if you are having a branch network and contact with the customer, then we'll be able to grow the gold. So there is enough scope and opportunity for gold financing. And especially at the time when the gold prices are going up, it's an extremely safe lending opportunity for us. And also to the existing customer of ours. There are many SME customers, two-wheeler customer, any customer for a small requirement, temporary requirement, a working capital requirement, he can go to the nearest office of ours and raise money. So that is the opportunity.
Yeah, it's a very powerful sort of instrument now with gold prices being where they are at the hands of the borrower, which is why just trying to get an estimate. Full year, what is your AUM target for gold loan growth?
See, we are at around 5,500 crores. We are planning for a growth of 20% plus. We should reach around 7,000 to 7,500 crores in this financial year.
All right, Mr. Revankar, thank you very much, sir. Good speaking with you. Thank you very much for joining us with those details. So 15% growth, credit costs 2% plus minus 0.5%, margins about 8.5%. These are what Shriram is aiming to do as we look ahead into FY26.
Interesting because the stock is trading at very juicy valuations, at the start of today and post the 7% downtick as well. If you look at it on the price to book or PE or even the return ratios. But for the timing, 15% frontline name getting a hit like that, in a couple of trading sessions, it's a little bit worrying.
Hearing him, you wonder whether 15%, where's such huge concern coming in? Because
management
doesn't sound so concerned.
The entire story of Shriram got re-rated. It was a merger, right? It was Shriram Transport Finance, Shriram City Union.
Yeah.
Transport Finance was lumpy. City Union was kind of stable.
Smaller business,
but stable.
Stable, yeah.
So that provided stability. And the business started re-rating 2 years back. Otherwise, it always used to be the cheapest, by far the cheapest NBFC.
Indeed.
So I don't know if the market is making too much of it. And it's not, because on Friday it was down, and I think as you guys said, over the last 2 weeks or so, it's down 13-14%. So it's actually the first hit we've seen in many, many quarters on the asset quality side.
I think on the valuation parameter, if you compare it with Chola, it's trading at 50% discount in comparison to it. So it's trading, I think, at around 1.5, 1.4 times or thereabouts.
All right, well, let's just quickly take a look at what the market is doing. So it was doing very well earlier when we looked at it 15 minutes back. Oh, wow, 188 points on the Nifty. So just shrugging off, some of these worries at the margin and just sort of charging ahead. 24,230 is where the Nifty is at. Is a 200-point pop, which we have. So this is basically a complete reversal of what we saw, almost a complete reversal of the 250-point drop that we saw coming through on Friday. So very, very good going so far. Market breadth is not wildly positive, but 1340 stocks are higher and about 1150 stocks are lower at this stage. And I mean, sectorally, if I just want to take a look at it, so it's oil and gas, defense, and PSUs. That's the bulk of where gains are coming in from. Maybe a pharma, FMCG. I mean, actually, very few things actually down and out. IT is a notable loser. It's the biggest 0.8, 0.9% cut on the IT index after the bounce that we saw, I guess, last week. Mitesh is with us. Mitesh, what would you do in terms of trades?
Good morning again, Prashant. I think a couple of names, Supreme Industries is one which has caught my attention today in the F&O segment. It's cleared the last few days of pivot of around 35. So keep the stop just below that. Look for target of around 36.75, 36.80 to begin with, and eventually one can look at even higher levels. The other stock which I like is Lupin, which is just at the 200 average. So here I'll give a conditional trade. If it starts getting past 2095, buy with a stop at about 2070 for a target of 2150.
Okay, all right, got it. Thanks, Mitesh, so much for that. We'll take a quick break, come back on the other side. We'll have Manisha Gupta joining in with the latest from the commodity markets. Welcome back. So the markets are cruising along 217 points higher. Mid-caps are also in fine form. Actually, all the key indices, Bank Nifty, Nifty, mid-cap, everything's up about 1%. So it's a good Monday morning, good start to trade. As promised, let's now shift the focus to the commodity markets. We have Manisha joining in with the latest. Manisha, good morning. So what did the weekend bring?
Well, profit taking in metals. So you have gold prices down almost 6% off from its all-time highs, and the metal prices are down by a percentage point in the Asian markets right now. But what seems to be doing better really is the crude oil prices. After that very sharp decline that we saw on Friday, when the prices fell by 2%, we have seen some bit of a opportunity buying coming into the markets. Well, the reason for that is that you have China and Politburo meeting over the weekend on stabilized jobs and unemployment insurance funds as well. There also is more conversation continuing, and in retaliation or on reaction to the tariffs, there is an expectation that China would be looking to increase consumption, and we could be looking at some more measures coming in. And then there is an explosion on the weekend at Iran's Bandar Abbas port on Sunday, and that has also added some premium to the prices. Markets also are seeing some support on the back of uncertainty in sense of trade talks in US and China, with an expectation that you could be looking at a step back from both of those countries coming in. US already has said that there are conversations going in, and there have been reports on how US has softened the rhetoric and China has exempted some US imports from 125% tariffs. But that's exactly where the bullish cues for the crude oil prices end. Because come the month of May, you will have OPEC and allies increasing supplies by 411,000 barrels per day. And the expectation is that you could be looking at more barrels being added from the month of June as well. Also, when you look at various statements, we do understand that there is some kind of a disagreement with various OPEC and allies members, Kazakhstan and Iraq especially, saying that they will be adding more barrels. So this disagreement also poses a downside risk when it comes to the crude oil prices. The US dollar index has strengthened. It's off its 3-year highs. You also have US-Iran reporting signing of progress in nuclear talks in this week itself. So those are some of the factors which have led to premium going off in sense of crude oil prices. IMF cutting US growth by to 1.8%, recession odds being added to 40% are some of the other factors also. So when you look at the prices, while we may be 1.5% up on a weekly basis, but in this year until now, we are down by 12% for the crude oil prices. And when you look at the last 12 months, we are down 24% in sense of crude prices. But this is going to be an important week because you have so much data coming every day of this week. Monday, that's today, you have Canadian federal elections. Tuesday, you have consumer confidence numbers coming in. If you look at Wednesday, you have first quarter GDP numbers, employment numbers, pending home sales, and Bank of Japan monetary policy meeting. That's also on Wednesday. Thursday is US weekly jobless claims, and on Friday, you have US non-farm payroll data. So as I said, every single day there is data coming in from the global markets, and that would set course ahead.
All right. Thank you very much. Commodities there in focus, Manisha. Appreciate it. Well, what's the MFI pack doing, the microfinance stocks doing? A news flow coming out of Tamil Nadu, a little disturbing from a lender's point of view. Abhishek, take it away.
Well, it began with Karnataka and now flowing into Tamil Nadu as well. So as per news report, Tamil Nadu money laundering entities bill 2025 has been laid down. The key objective over there is to protect economically weaker sections from coercive practices by money lending entities. So there are three key provisions which have been mentioned over there. 3-year jail term for coercive recoveries. Loan recovery agents can be penalized for harassing borrowers or their family members. Microfinance institutions are prohibited from forcibly collecting dues, and dues to be resolved through district level committees only. So the impact on MFI companies would be that there would be a short-term impact with respect to disruption in their operations and collection efficiency over there. So there can be a dip in collection efficiency as and when this gets implemented. A potential exception would be the MFIs registered and regulated by RBI might be kept out of the bill's ambit. So state-specific impact with reference to the percentage of book or presence over there. Tamil Nadu accounts for significant portion of AUM for microfinance entities like Credac, almost 20%, LNT Finance, around 20% of the rural branch network is in the state of Tamil Nadu. Equita Small Finance Bank has a huge presence in the state of Tamil Nadu as well. Others who have smaller exposure over there, Fusion Microfinance that has about 6 to 7% exposure over there, and Spandana less than 2 or 3% of their book is in the state of Tamil Nadu. Back to you.
Okay, all right, got that. Abhishek, thank you very much for the details over there. We need to take a quick break. On the other side, we will be chatting with the management of IDFC First Bank, talk about the bank's fourth quarter performance and the outlook ahead.
Okay, we continue with our earnings analysis, and IDFC First Bank is in focus. It reported a weak set of numbers compared to what the market was expecting. Net interest income and profit after tax came in below CNBC-TV18 polls, while FY25 credit cost ratio was above even the company's own guidance. However, the non-MFI stress was stable quarter on quarter, and that is a very big positive. To discuss these and more, we have with us the big man himself, V. Vaidyanathan, Managing Director and CEO at IDFC First Bank. Good morning, Mr. Vaidyanathan. Thank you very much indeed for your time. Actually, the market is worried about both stress and income because the numbers came in adverse. Can you first tell us about this whole credit cost issue? It's high. How do you see it going? It's higher than the guidance.
Well, actually, it's playing to script. Let's be very, let's put the numbers out properly out there. 2.45% is a credit cost for this year for the bank. And this includes the impact of the MFI and also includes the impact of that Mumbai entry point toll road issue, which is a legacy, the infrastructure account. If you take this thing out, because we'll talk about them separately, it's only 1.76%. And our gross NPA is holding up at about 1.87%. Net NPA is 0.83%. The credit cost, to complete the picture, is 1.76%, excluding those two items. So actually, this is, like you rightly pointed out, that our MFI has been higher, but our core book, that's really good news, that it's very stable.
Okay. Would you say the worst of MFI stress is over?
Yes. Which, we should be very watchful. It's a very sensitive segment. I want to be really watchful. But let me just say that as we had said the last quarter, I had spoken at your channel also, we had said that Q4 will be the peak of provision. And then we said in Q1 should be less than Q4 and Q2 and so on progressively. We feel definitely it's progressing on this direction as far as eyes can see. And best part of being able to establish that is the SMA pool, because SMA feeds to NP and provisions and all that. So our SMA pool has come down from 777 crores to 640 crores. So that is SMA 012 put together for MFI. The whole block has come down. So naturally in the subsequent quarters, provision should come down.
Okay. Can you take us also through income? Your costs are high, obviously, because you're building the bank. But income has also kind of faltered. What kind of, income growth or interest income growth can you, guide us?
So income also, this MFI thing is affected on two fronts. We talked of credit costs. I don't repeat that because it is higher than expected. I also agree. It was high. But coming back to, but frankly, that happened to all the 200 players who played in this market. We are not the only players. But the other impact of MFI also was income, because we shrank the book, just for the record. We shrank the book of 13,500 crores as of March 31, 2024. So 9,500 crores is a big dip of 44,000 crores. So that also brought down income with it, because the yield on this book was like 23-24%.
So it's an interest reversal, is it?
No, the book shrank. So you accrue less income. Like I told you, numbers. So basically the book, so composition of MFI in the book has come down from 7% 1 year ago to now 5 maybe 4.8% now. Next year will come down to 3%. So net, we have ambitions of being, a large bank. We don't want to forever be in the mid-tier bank. We want to be a larger bank category. And MFI cannot be a big portion of a book. So that is a phenomenon playing out. But to estimate the next year, let me put it like that, to your question. So we expect our OPEX to further moderate next year. Our OPEX growth last year was only 16%. Next year we're guiding to be like 13%. So OPEX coming down is a very material movement that should impact the operating profit and the PAT of the bank next year. But certainly short point is that we expect that 26 numbers of PAT to be much, much better than 25.
Actually, you took away my next question. I did want to talk to you about OPEX. Over 4,000 crores, right? Now, this near almost 5,000 crores. 4,991 is the OPEX. Now, this is like, pretty close to, say, Kotak's OPEX or something. And they have many, many more branches. So, what explains such a large OPEX? And when will you be able to milk it? Because that also means cost to income is among the highest in the industry.
Yes, that's absolutely correct. So basically, we added, Lata, we had 200 branches 5 years ago. We have 1,000 branches now. We had 200 ATMs. We have 1,100 ATMs. We hired the people. We put up the infrastructure, the whole thing. We start up so many lines of businesses like cash management and FASTag and credit cards and the liability franchise, the current account. It's a new bank coming up. All things had to be spent. So that's the way it is. So, but the good news is that now incremental, let me just tell you 4 numbers. It will help you very easy to understand. YOY growth on OPEX for Q1 of last year was 21%. Q2 YOY growth was 18. Q3 was 16. Q4 is 12. You can clearly see we are really clamping down on OPEX now. And next year, we expect this to be only about 13%. So we are really going after OPEX. And there are many ways of going after it. And that, we believe, is a material reason why our PAT also should look up next year. The other thing, Lata, is that I want to just put the correct numbers in front of everybody so that it's very clear to expect from us. While the loan book next year may grow up by about 20%, income growth will be like 14% because the microfinance component as a percentage will come down. But income comes down, income grows at a slower pace, but OPEX also grows at a slower pace. Operating profit will still improve next year meaningfully.
Okay. So the slowdown in income growth will be countered by the slowdown in OPEX growth as well, is what you're saying.
Absolutely. Right? And the year after that, now the bank is really well set because the machine's running, good franchise, good brand, all that has come. Now, when you look forward, let me say just 1 year forward, I don't want to get too far away, but let me say 27, we expect the income, OPEX to still grow only by that zone, like 13%, but we believe income will go up by 18, because by that time, the microfinance would be in the base case itself. So I really expect that 27 to be materially improved and 26 also to be much better than 25.
Okay. But that also because you're stressing less on microfinance, your margins are coming down. I mean, you were 6+. Now you are a little short of 6% in terms of margins. What's the trend? If that will go down, then that again hurts income, hurts ROA.
No, it's true. Absolutely, you're right. You called it right. So the way we look at, I'll just put some numbers out to just put some full clarity on this. So on the margins front, last quarter, which come down to something like 595, as we progress to becoming a large bank, I told you our ambitions of becoming one of them. So there'll be some sort of a moderation there. But let me give you a next 1 year picture. So we expect the repo rates to already come down to 25 basis points last quarter. We expect another 50 basis points to happen. So to the extent we have 30% of a book is linked to repo, we do expect the income to dip according to the amount. But good thing is that we're also going to cut the cost of deposits. Only today, it might be just fresh off the press, we brought down our interest rates on fixed deposits to as low as the large banks. Okay. It's a very material development for us, like as low as the big banks. And, it was like a 200 basis points more than those banks 3, 4, 5 years ago. It's now like match the rates. So when we drop the rates also, this also will come down. But together, impact on margin next year should be 10 basis points over Q4 of FY25.
So 5.85 is what we should be prepared for, you're saying?
For next year, vis-a-vis 595 of this year.
Yeah, no, I see, that is understandable. You cannot always be at the 6% mark. But ultimately, as your OPEX, everything will crystallize in the ROA. So give us an ROA guidance. That also has fallen, which may, that perhaps explains why your stock is down 1.2% on a day when the market is up. The ROA would be a disappointment. What would your guidance be?
So we believe that by end of this financial year, we should go back to the 1% kind of a leak. And I agree, it's like 0.3, 0.4%. We had that twin impact, right? Income came down, credit cost went up. That's a strange combination of events came together from MFI. As the impact of MFI recedes over the next 4 quarters, ROA should come back to 1% is what we are working towards.
Okay. Do you release some money because of the lower LCR rules, especially in wholesale and even in retail, lower than at least the draft?
Well, it's much better than the draft guidelines. in the draft guidelines, as per them, it is much benign because the draft guidelines, we had to put out 10,000 crores of extra cash to meet LCR. In the new guideline, our expectation is about 1,000 crores. So it's like markedly better, and 1,000 crores for a big bank like us is really nothing, or for a size of our bank, really nothing. Think of it like 1 or 2 basis points.
Oh, that's excellent. So that also reduces costs or at least improves margins in a big way. You have more money to lend to more profitable areas. So give us a guidance in terms of growth. Okay, the other vertical. What is the vertical you see giving you growth now that you've pulled back a little from microfinance? Will it be SME, MSME? What is your growth lever? So
there are 4 segments we work with. One is the retail segment. Second is the SME segment. Third is the commercial segment. Commercial is the sitting between SME to the large corporate, that commercial segment. The fourth is the corporate segment. And fifth is the agri segment. Think of it like these 5 sectors. And there will also MFI. So we will, of course, mute MFI because, like I said, we don't want to be hostage to one product holding the bank hostage to numbers. So we will mute that. But the all other businesses are set for growth. In fact, since I'm on a channel, let me also say that we are looking to build a commercial banking team, the one that sits between the small corporate and large corporate. And we are looking to build a proper team there. So anybody hearing the program want to reach out to us for a proper role, I'll be happy to.
Okay. No, I wanted to, just a final squeeze in a question, though we are being warned of end of time. Your cost per branch. Now, I have not done this math. It has come from someone who's watching this show and is sending the question. He says your cost per branch is as high as 19 crore, whereas for ICICI, HDFC Bank, Bank of Maharashtra, it's much lower at about 6-7 crores. Any reason why your branch, first of all, is this number right? Is your branch cost that much higher than your previous employer, ICICI? And why?
No, my previous employer is a great bank. But let me just say that these numbers are not are absolutely wrong. Actually, very misleading way of comparing banks, actually, because cost per branch is pretty much the same like every other bank, except that we are less branch-heavy bank. We have only 1,000 branches, and we are originating 50,000 crores a year of deposits because our digital machinery is running a very big way. And then we have so many other businesses that are running. Like imagine we're setting a card business. If you go load the card OPEX or a cash management OPEX onto a branch, how does it make sense? So these numbers are not exactly the right benchmark. The real thing is the bank has many new lines of business launched, which we had to do, and they all have a cost. So they have to look for their own independent paybacks and stuff, and they should not, you should not load them to a cost of a branch. A branch cost is similar to other banks.
Okay, your previous great employer, KV Kamath, spoke to me recently. And, as he looked into the future, he said banks, given the way in which fintechs have come in and, technologies coming into the NBFCs, he said banks will have to cut their credit, their cost to income to 1/4 their current number. And he was looking at, ICICI and saying they have to go down to 15%. Give us some guidance. What does your cost to income is sitting at 75? Where does it go to, say, in 2 years, in 3 years?
We think that a good, stable cost income of today's modern times, at this point of time, I agree with Mr. Kamath about the longer picture. But for now, it's more like the 50s, 40s, 50s, let me say late 40s kind of stuff.
Okay.
So we have no doubt that we will get there. Like, we have zero doubt because it's just a scale. Nobody should forget. It's a 5-year-old bank or a 6-year-old bank. Those banks are 25, 30-year-old banks.
Yes.
It really can't compare. But markets are markets, they always compare. So in the long run, I have no doubt in my head that we will get there. And I'll give you one number about how technology is really helping Tata in this cost-to-income ratio. Last year, we added only 58 branches. But our deposits went up by 25%. That is, we grew the branches by 7%, deposit up 25%. This year, we're planning to add branches only by 10%, but we expect deposits to grow by 23, 24%.
Yes.
So the power of technology is really showing at our bank, and we believe it will be material progress for the bank in the future. And finally, it's also helping a customer experience.
Okay, no, there's no taking away that everyone who looks at your bank is impressed by the deposit growth, even under very difficult circumstances. Take your point with that, and congratulations for that. Thank you very much for joining us, Mr. Vaidyanathan. Out of time, we have to wrap up on Bazaar. On that note, the market's still in very high spirits. Chartbusters will take the action forward.